scoring a legal victory today. The second largest court in the European Union overturned a nearly $1.7 billion fine that was imposed on Google over apparent abuse of its dominance in the ad space. The win comes after Google lost an antitrust case in the U.S. last month that concerned monopolistic charges in its search business. We are just hours away from the Federal Reserve's September policy decision. With more on what to expect today is Yahoo Finance Fed correspondent Jennifer Schonberger. This is like your Super Bowl, Jennifer.
Yes, it was the day we've been waiting for since late last year, Brad. The Federal Reserve widely expected to lower interest rates this afternoon for the first time in 4 years and chart a course forward for future rate cuts. But the big question on investors' minds is just how much the Federal Reserve could cut rates this afternoon. A 25 basis point rate cut was largely expected on the back of the most recent jobs and inflation reports, but expectations have now swung more towards a bigger 50 basis point cut, leaving the possibility that the Fed could actually cut by that amount, something that had not been previously thought. Now, if the Fed cuts by 25 basis points, that would bring the benchmark interest rate to a new range of 5 to 5.25%. If the Fed cuts by 50, that would bring the policy rate back into the fours in a range of 4.75 to 5%. Aside from how much officials cut today, more important, how many rate cuts they see for the remainder of this year and next year. Many Fed watchers, including former Kansas City Fed President Esther George, expect a baseline of 3 rate cuts this fall, one 25 basis point cut per meeting, with many more cuts next year, but likely short of the 10 the market is pricing in now. Now, it will be up to Fed Chair Jay Powell to explain the interest rate projections in the press conference following the meeting and either lay the groundwork for deeper, more aggressive cuts at subsequent meetings or say that the Fed is expected to take a measured, gradual approach and is prepared to take more aggressive action if warranted. Also expect lots of changes to the Fed's policy statement to reflect the Fed's decision to embark on a series of rate cuts, including that officials have gained confidence that inflation is falling back to 2% and that future rate cuts, the size and timing of those, will depend on the data. Back to you.
All right, Jennifer, thanks so much. Appreciate it. Hope you have a great Super Bowl today.
Thank you.
Also, a reminder to our viewers, that decision is going to be out at 2 p.m. Eastern, followed by Fed Chair Powell's press conference at 2:30. Yahoo Finance will bring you coverage of today's meeting starting at 2 p.m. Eastern, so stick around for all of that. Now, Wall Street is bracing for a very anticipated Fed meeting, one of the most anticipated in recent memory. Both a quarter point and a half point rate cut are still on the table. Joining us now to discuss, we've got Bill Adams, Comerica Bank's chief economist. Bill, it's great to speak with you. So, listen, I'm fascinated in the degree to which the market has repriced around a 50 basis point cut. I certainly didn't get the sense from Powell that that was going to be possible in his Jackson Hole remarks. Do you think the market is going to end up disappointed and potentially a bit offsides today if we do just get a standard 25 basis point cut? What's your base case?
Hi, Madison, and thank you for having me on. I think I see a 25 basis point cut as a bit more likely than a 50 basis point cut, honestly. The economy is in a pretty good place. Economic growth is holding up in the third quarter. We had that really nice retail sales report, the nice industrial production report out earlier this week. And so I don't think there's a lot of urgency from the Fed's perspective to support the overall economic growth. The Fed has seen the labor market loosen. And I think that is supporting the rationale for a bit more support to the economic expansion. But I think whether it's 50 basis points or 25 basis points, as long as the Fed signals that they expect to make substantial further cuts into 2025, I think that will provide the reassurance that financial markets and the economy more broadly needs, that those interest rate sensitive sectors can rebound next year.
Does even the expectation of, or perhaps a high hope of a 50 basis point cut by some out there, and as we're continuing to monitor the probability, with that still being part of the thought process as of this juncture, does that just signal to you that some of the recession fears out there might be overdone?
I don't think it's likely that we're in a recession. I don't see a recession around the corner. Now, the big recession indicator that I and many others have been watching in the last 2 months is the SOM indicator, where we have seen a substantial uptick in the unemployment rate over the last year. And historically, when the unemployment rate's risen as much as it has, the economy has been in recession. But this time, knock on wood, seems different because we're seeing very rapid labor force growth in 2024, partially because of immigration and partially because labor force participation is rising among people between ages 25 and 54. It's the highest since the early 2000s. And when you see an economy that's rapidly adding workers and job seekers, you could have the unemployment moving up despite adding jobs. So jobs are growing, but they're not growing fast enough to keep up with growth of the workforce. And I think that is supporting those expectations for potentially a larger cut.
So to what extent are there factors that are outside of the Fed's control that will not be reactive to rate cuts?
Fiscal policy is the big one out there right now. Fiscal policy has been very expansionary over the last 2 years, been a bit less expansionary in 2024. We saw a big increase in income tax receipts from the government and corporate tax receipts from the government this April. And that's partially reflecting the good news that the stock market did really well in 2023. So there were higher capital gains due from taxpayers this tax season. But expansionary fiscal policy means that there's less pressure on the Fed to have expansionary monetary policy or less restrictive monetary policy. And that's one of the reasons why Comerica forecasts that the Fed is going to cut by, only a 0.25% this meeting. Even this quote unquote only, it's still, we're still on course for substantially more loosening of monetary policy over the next 12 months than seemed likely, at mid-year, much less in April after we saw an uptick in inflation in January and February. So I think that the big picture is still that monetary policy looks set to loosen substantially, and that's going to support economic growth.
Given that, I'm curious from your perspective, do you think that the dot plot or any indication about the Fed's path forward to that neutral rate is potentially going to matter more today than whether or not we get 25 or 50?
I think forward guidance is going to matter more than the immediate decision. The funny thing about the dot plot is that it's all the members of the Federal Open Market Committee, and not every dot gets a vote every meeting. There's the FOMC presidents of the regional Fed branches. They have rotating votes, and they tend to be more hawkish than the Fed governors in Washington. And so every time I read the dot plot, it's sort of like an opinion poll of all American adults versus people who voted in the last election. It tells you a different message about what people want, how people think they should vote versus how they're actually going to vote and what the actual vote on monetary policy will be. So I think actual policy is going to probably end up more dovish than what we see in the dot plot. And I will watch for Chair Powell's comments for kind of a more specific guidance there.
And since you had previously mentioned fiscal policy, I do want to ask you about the upcoming election. There is a chance that come that November meeting for the Fed, they don't know who won the presidential election, and they can't therefore kind of price in the potential impact of fiscal policy to come when it comes to inflation. To what extent do you think then that they might want to go 50 today to get ahead of any unknowns regarding the presidential election in that November vote?
I expect the Fed to make the November decision based on what's going on with inflation and the labor indicators, and probably to not have the election factor into that decision. And I've been reminding Comerica's clients for the last couple of months, and we're still talking about it, that Fiscal policy depends as much or more on what happens in Congress and the Senate. Congress and the Senate have to vote on fiscal policy, have to pass the fiscal policy. So the presidential election is what's eating up all the bandwidth, but what happens in the legislative branch is really going to determine what happens with fiscal policy.
Bill Adams, Comerica Bank Chief Economist. Bill, great to get some insights and perspective ahead of this big decision, just hours away from it. Thanks so much.
Thanks for having me.
Certainly. Well, we are just hours away from the long-awaited Fed decision where they are likely to cut rates, but the extent to which, unknown right now. To take a closer look at what's moving ahead of the potential cut, we've got Yahoo Finance's very own Jared Blickery. Jared, what are you tracking out there?
Thank you, Brad. I'm looking at stock futures right now in the green for the most part, but we do have the Russell 2000. That's that little red spot you see right there, but the major indices not doing a whole lot, and they weren't doing a whole lot yesterday. A lot of times we talk about FOMC drift. That's a thing where stocks and stock futures kind of drift open or drift to the upside usually ahead of the announcement. But let's check out what's going on in gold. I've been finding that really interesting recently. Here are gold futures over the last 3 days. And let me put a year-to-date chart. Gold is one of the best performing assets of the year. You can see up 26%, hitting another record high likely or close to it right now. 2,600, a key level to watch there. And I'm writing about silver in the morning brief. We've seen silver pick up recently. It's not moving a whole lot right now. In fact, it's not moving at all. But we do have this interesting bull flag on this year-to-date action right here. And we can see, let me just circle that right there. We can see we're just trying to break out to the upside. And on a 5-year basis, you can see how these levels have played over time. We are right up by the Rubicon, or roughly the Rubicon right there. Let's get into some sector action where we are seeing tech in the forefront, but that's only up about 26 basis points ahead of the open. Then we have consumer discretionary, then we have financials, communication services, real estate. Staples is in the red, but only to about 23 basis points to the downside. And then energy and materials also rounding out those in the red. Brad.
All right, Jared, thanks so much. We're just about 15 minutes outside of the beginning of today's trading activity. We will see exactly how this transpires throughout the rest of today's trade. Thanks so much, Jared. Also, everyone, as we mentioned, stock futures, they're still holding on to some gains ahead of the Fed's policy decision later this afternoon. The start of the easing cycle may yield more gains for an already strong market. Here with his take is John Stoltzfus, who is the Oppenheimer Chief Investment Strategist. John, great to have you here with us. I mean, which camp are you in? We just got to know that. 50, 25, and how much volatility does potential 50 throw into the mix right now?
Brad, great to be here on Yahoo Finance. Would have to say that we're looking for 25 bips, and we felt that way for quite a while. We had, thought before the last few months that it would likely be November and December that the Fed would begin cutting. But we think that the Fed chairman's mentioned that, they're going to expand their view here to emphasize the labor market in their dual mandate. Now, we know it's going to happen today. 99% sure, you never know, but we think it's 25 bips, 50 bips. The problem here is that there's a lot of big money that is highly leveraged that's pushing for a 50 bips cut. That's the crowd that believes, that it's closer to a recession than not. We're not in that camp. We think the Fed has done a great job, and it's 25 bips today.
Yeah, the market repricing into 50, John, has absolutely fascinated me. It's been my Roman Empire over the past couple of weeks here. But I am curious. I know that we are within 1% of all-time highs, certainly inching closer to your year-end price target around 5,900, I believe. Is today an inflection point for this market?
It is, but likely not today in essence, but a little further down the road. We think, if anything, today, the 25 bips is likely to be greeted by the trading floors as time to sell the news after having bought the rumor. On the other hand, if it's 50 bips, the crowd that's looking for all those cuts from into next year, we think that they'll likely say there's some kind of a problem and recession risk is rising. So I don't think today will be a pronouncedly up day. If it is, I'll take it. But I won't be surprised to see, sideways movement or a drift slightly lower. or maybe a little bit more, not panic, but most certainly, some kind of negative pitch book throwing things down if the 50 bips crowd is annoyed and wants to throw a tantrum.
Give us the trade for both of these outcomes, John. 50 versus 25.
Brad, we have been big on cyclicals over defensives because we believe the Fed has done the right thing. Business has managed this transitional period back to sustainable growth. The consumer has shown up, whether you look at retail sales, even manufacturing, at least in the most recent data, looks like it's begun to pick up again. So we'd have to say that, where we are right now, it would be technology, communication services, consumer discretionary, and financials we think are very important to own at this point. And of course, the industrials, with the likelihood that this year the government will finally get around to really spending all that money they set aside to invest in onshoring.
John, help me out in terms of the degree of upside movement that we're seeing in financials as we're heading into a rate cutting cycle, and how we can hold that view while still holding the view that tech is going to continue to rally. I don't get that.
Yeah, we think, related to financials, the big thing is what you want to look at is a normalization of the yield curve and the economy showing enough strength to continue to produce resilience. We're big on the large cap financials. Related to the regionals, we still think it's a little bit more of a risky bet in terms of what the individual companies within those indices that cover the regionals and the stocks themselves in terms of their exposure to big businesses that are trying to get their employees back to the office and are having difficulty doing it. And the questions related to what do you do with buildings that you can't repurpose? So that issue remains a concern. But the big banks look like very well positioned here to continue a rally point, which they have begun in the second half of the year.
John, before we let you go, I want to get your take on some commentary we got from Jamie Dimon over the past 24 hours saying that the Fed rate cut is, quote, not going to be earth-shattering. The market's certainly not acting like that, though. Who's right here?
I've got to say that I think he's got a good point here that in actuality, especially in hindsight, in the rearview mirror, when we look back at today and all the angst and debate as to what the Fed was going to do and what would be the outcome, that it will be a lot less important than it appears. The most important part of it is it's a beginning, a down payment by the Fed for Wall Street and Main Street to see that this is the beginning of the end of the rate hike cycle. His comments related to where the 10-year could trade, what is it? I don't know, 3 to 8% or something like that. At one point, I'm not absolutely positive. That's what I recall. You've got to figure. I think he's on the high side of that band. I think that's a little bit worrisome. But I think that's outside reality that we'll get to see. I think the Fed's doing a good job. I think the 10-year is probably going to trade from around to be priced to yield 3.7 to around 5%. Probably for the next year and a half. I think inflation, is something that takes a while to get rid of, but the Fed has really made remarkable progress in bringing it down to the 2.5–3% area. So here we go.
Here we go indeed, John. Thank you so much for joining us on this very special day. We really appreciate it.
Thank you.
And a reminder to our viewers, that decision coming out at 2 p.m. Eastern, followed by Fed Chair Powell's press conference at 2:30. Yahoo Finance will bring you coverage of today's meeting starting at 2 p.m. And a big win for Google. An EU court approving the big tech company's appeal to overturn a nearly $1.7 billion antitrust fine over its online advertising practices. Here with us now, we got Yahoo Finance senior legal reporter Alexis Keenan and tech editor Dan Howley. Thank you both for being here. Alexis, I want to start with you on the legal side of things. Talk me through what happened and the ramifications.
Okay, so this is the second highest court in the EU, and so therefore this decision is is appealable, so let's keep that in mind. But what they did is they said, we're going to toss out this $1.7 billion fine. We agree with the findings of the European Commission, the antitrust regulator there, but we're not going to go with this fine because they felt like the contracts at issue in this case that had to do with Google's AdSense product hadn't been considered properly in assessing that fine. Now, I think we have a screen to show you what this case is about. And the AdSense product, it's a publisher-side tool. And what it does is it allows website owners to monetize their websites with Google Ads. What this case said is that Google was blocking when a website would run this Google Ads within their own site, blocking the premium placement for its own purposes. So the EC can definitely appeal, but look, they're not totally out of the woods in terms of fines and antitrust, as we talk about almost every day here at Yahoo Finance. If you just take a look at the different disputes and litigations around antitrust that are playing out in the UK and the US, you can just see them there. So this 2019 fine that is appealable, let's just put that in context with the billions of other dollars that are at stake for its various products for Google.
Yeah, so Dan, they've won this court challenge, but I mean, what does this spell out more largely about how investors need to continue to think about where the monopolistic allegations that have come forward could impact Google's business from this point out, even if they have to make their own proactive or reactive adjustments because of these cases?
Yeah, I mean, look, I think the main case is still the U.S. one, right? The one that we talk about when it comes to search, but also the one related to ad tech. Those two are the ones that I think are going to have the biggest impact on Google overall. I mean, Google and the EU have been going back and forth for years. Right? It's just basically like, tit for tat. We're going to say you're doing this. We're going to deny we're doing anything. And then, years later, we'll figure something out.
And broader U.S. tech companies have been under the microscope by the EU over the last several years.
Yeah. The EU is kind of the first to really kind of take the reins and say, look, we believe that these companies are breaking antitrust law, and we're going to hold them accountable for it. And so for Google, I think really, though, the U.S. Search suit where they say that they paid Apple or they're paying Apple and Samsung to basically be the primary search engine on everybody's iPhone and everybody's Android device. That is unfair. They're blocking out competitors like Microsoft. And I think the ad tech one where they basically work both sides of the business, that's also a large deal because one is their big search business. Everybody gets eyeballs there. That then leads to ads. And so it's both points, right? It's like just downhill from the search. You go search, advertising shows up. And so taking on these two big businesses in the U.S. at least is going to be a big problem. The U.S. is also where a lot of companies generate the bulk of their revenue when it comes to advertising. And so losing ads in the U.S. where they're premium is going to be a bigger issue if that ends up happening.
All right, it's massive. We're going to continue to track, of course, the ticker symbol going into the open and as all of these future cases transpire as well. Alexis Keenan, Dan Howley, thanks so much for helping us break this down this morning. Coming up, everyone, we're taking a closer look at what's trending on Yahoo Finance and breaking down why they're moving. We've got that right after the break. Now time for some of today's trending tickers here. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First, let's talk a little GIS. That's the ticker symbol, the company name, General Mills. The shares right now down by about 2%. The consumer food maker's first quarter, the profit there dropped compared to last year, but posted a smaller than expected drop in quarterly sales thanks to higher prices on some of its snacks. General Mills also reaffirming its 2025 forecast and expects volume trends to improve next year. The company's CEO, Jeff Harmening, saying the top priority in fiscal 2025 for the company is to accelerate organic net sales growth, and then they made some progress on that goal in the first quarter among multiple fronts, but still more work ahead, and also trying to provide some more what they call remarkable experiences to consumers. I mean, when you have some cereal, how is cereal not remarkable?
I mean, I think you know as well as anyone, Brad, that General Mills is also now getting into the pet space, right? So maybe they're transitioning away.
It was interesting for the pet space, yeah. That segment was certainly one of the better performers during the quarter.
Yeah, and it's fascinating to your point. Obviously, when you think General Mills, you think of the cereal business, but it seems like they're going to have to really start kind of diversifying away from that. Having said that, just now crossing the wire, we have some commentary from Mizuho on this General Mills print saying, quote, they delivered encouraging beats on revenue and gross margin and strong data when it comes to their market share in North America. They also say that defensive rotation has already been discounted by improving fundamentals in their shares, but they do note that the company is improving on their execution, so there's a little bit of a risk-reward ratio to kind of suss out amongst investors, so they're keeping their neutral rating on this name.
And when I say pet was one of the better performers, it was really more so on volume than it was actual sales.
Interesting.
We should mention that because there was some price adjustments that they made during the quarter, as well as renaming it to the North America, I believe, pet category for the company.
Yeah, fascinating to see how kind of price cuts that these firms are having to make are starting to impact their company earnings. But quickly, let's get to Intuitive Machines stock soaring today after the space exploration company secures a contract with NASA that could be worth about $5 billion. Take a look at that stock, up nearly 55% right now. The company saying this contract is for communication and navigation services for missions in the near space region. The contract has a base period for 5 years with an additional 5-year option period. And the one thing I like to note when it comes to contracts like this has certainly impacted Intuitive previously. Once NASA knows you can come through on a contract, they're typically going to re-sign with you. So that could be a more bullish signal moving forward.
Yeah, quick comment from me. As part of this contract, the company is especially going to help deploy lunar relay satellites, provide communication nav services as well. Short for navigation services that play an essential role in NASA's Artemis campaign to establish a long-term presence on the moon. So, hey, we're taking you from the equity markets to the moon here today.
That's exactly right, Brad. And we are going to get to the opening bell on Wall Street here in a moment. So it'll be interesting to see how the market opens, given that we are in a highly anticipation mode for our Super Bowl of the day, that big Fed meeting, whether or not we're going to get 25 basis point cut or a 50 basis point cut, Brad.
You got Susan G. Komen, Susan G. ringing the opening bell at the New York Stock Exchange ahead of Breast Cancer Awareness Month. And of course, as we're seeing a lot of pink down there, of course, always a great time to recognize and some of the work that Susie G. Komen does all year round as well here. Also, everyone, the Nasdaq, you're taking a look at SSNC ringing the opening bell there. So we've got some great bell ringers on the screen. We've got some significant movement here in the markets to start today's trading activity. Let's take a look at the Dow Jones Industrial Average. As of right now, it's actually flat, just barely to the downside here. Take a look at that, 41 points in the red as of right now. It was higher for much of the futures activity, but we've seen a little slippage here. The Nasdaq Composite out the gate, it's up by about 0.2%. S&P 500, you're seeing that flat, barely to the upside here. And then additionally, let's take a look at some of the sector activity as we always do here. 11 S&P 500 sectors. We've got them pulled up for you here on the Wi-Fi Interactive. As of right now, oh yeah, take a look at consumer discretionary leading the pack here. It's in front, but only by 0.25%. Utilities bringing up the caboose as of this juncture. Right now, that's down by about 0.4%. 0.1%. We'll round that off too. And we'll give you a year-to-date look at that because it's been pretty good. It's up 24%, holding on to them gains over the course of 2024 thus far here. So we're knocking on the door of Q4 in about 2 weeks here, Maddie. So we'll see if utilities can continue that run. But as of here today, taking a bit of a breather.
Taking a bit of a breather, which makes sense given that we've seen such a run in utilities heading into anticipation of those rate cuts. And now today we've got the big day. But let's get to Yahoo Finance's Jared Blickery for a broader look at what is moving in the market today. Hey, Jared.
Why, thank you, Maddie. I'm going to do a little magic trick. Let's put up the Wi-Fi Interactive behind me, and I'm going to take this sector action for today, and I'm going to put it on the year to date. And here we do see, indeed, utilities up 24%, leading the pack for the year, followed by communication services and financials. So that's a pretty broad swath of the economy represented right there. And what you're going to notice is there's no tech. XLK down here on the bottom row, still up about 14%. But I wanted to focus on the indexes for a little bit. Here's the S&P 500. What has happened this week? So it is up a whopping 16 basis points. Brian Dietrich over at Carson Group is talking about what happens in these situations when the Fed cuts rate with stocks near all-time highs. Now, he's saying the S&P 500 was higher a year later 20 times, and the S&P 500 at all-time highs right now, and the Fed is cutting tomorrow, which is today right now. So we'll have to see how that works out. We have seen the VIX. This is prime time season for the VIX to shoot up, but we're not seeing completely elevated levels right here. 18 is not historically high, but it's not extremely low either. So kind of in the middle. And there is a look at the VIX this week. Guys?
All right, Jared, thanks so much. Appreciate it. Teeing up today's market activity for us. Another trending ticker that we're following here at the open, shares of Roku. They are rising right now. JP Morgan and Seaport Global Securities both getting a little bit more bullish here, raising the streaming platform's price target. JP Morgan bumping it to $90. That's up from $80, plus reaffirming an overweight rating here, citing its expectation for revenue growth to accelerate in Q4 of next year. And then you've got Seaport. We mentioned them. They raised Roku's price target to $85 from $74 and maintained its buy rating here. So two more optimistic calls here on the street out the gate here for Roku early this morning.
Yeah, definitely. I want to take a look at Roku stock year to date because they're down a little over 13% on the year, but obviously recovering due to these lifts that we've seen. You can see kind of, I don't want to call it a hockey stick, but the lift that they've seen since the August lows in this stock. And there have been a couple of bullish signals, right? We're mentioning, of course, the price target upgrades from today, but these are not the only upgrades to Roku. Earlier in September, we had Wells Fargo upgrading on potential increased revenue streams for the platform. We also had some news about Wolf upgrading on sales growth and falling risks. And then a big one I want to point out, Cathie Wood's ARK Investment Management Fund buying over 150,000 shares of the company Shopify, but selling off Roku. And I think that's really interesting given the degree of price target raises we've seen in Roku. Then she came in just 2 days ago and sold off a bunch of shares. So interesting to see her kind of differentiating from the street when it comes to her view on Roku.
Yeah, I think the key profitability catalyst, if you will, for Roku here that we're starting to hear a lot more from the street is how well they're going to be able to continue to build on top of the ad experience for the different tiers that they do have, and making sure that for whichever tier consumers are buying into, for that ad experience, that you actually look across the trove of companies that are looking at Netflix, looking at Disney and the bundling that they're doing and the number of tiers that are ad supported. So with all the new ad supported tiers that have certainly come into the market over the past year, 18 months, for Roku being able to capture a percentage and grow out that percentage of the market here is going to be critical, because that is the most margin driven portion of many of these businesses right now, if you can layer in ads successfully as well, whether that be pre-roll, mid-roll, post-roll, just roll them.
Just roll them and rake in the dough as a result, Brad. All right, well, we'll certainly continue to cover the stock moving forward. Having said that, though, coming up, we're going to continue our opening bell coverage. We'll also speak with an investor who says this bull market is not going away anytime soon, but there could be some bumps ahead. Details next on Morning Brief. U.S. stocks trading softly ahead of the FOMC rate decision out today. While our next guest sees more room to run for the bull market, he does not expect it to be freed from volatility. Joining us for more, we've got Keith Lerner, Truist Co-Chief Investment Officer and Chief Market Strategist. Keith, it's always great to have you. So I am curious, the market really pricing in this higher chance than previously of a 50 basis point cut. If the Fed does come in more dovish than the market is currently pricing in, is the riskiness associated with that going to be short-lived, something that we'll see rock the market over the next couple of days, or could it potentially represent a sea change that could impact this market for the rest of the year?
Yeah. Well, first, Madison, great to be with you, and Brad, as always. It's the most important Fed day ever after the most important employment day ever. So it's interesting how much focus there is. So listen, I do think what happens today will matter for the next few days. You often also have like a knee-jerk reaction. So the first move after the Fed meeting, typically there's a knee-jerk reaction the other way at some point as well. But I actually think as you move past this, that the market will start focusing on corporate profits again and earnings and the economy. But in the near term, so the next week to few weeks, I think this will be a key driver. And what you've seen this morning is the Fed funds future is starting to tighten up a bit more. It was showing yesterday about a 67% chance of a 50 basis point cut, and now this morning it's about 59%. So it's the market's looking at this as a coin toss at this time.
Keith, I'm continuing to kind of joust mentally with, is it better for the Fed to taper over time and begin with 50 and then taper down 25, and then perhaps that just kind of sputters out over time as they start to communicate whatever a terminal rate looks like? Or is it better to just tease teardrops, if you will, of 25 basis point cuts over time until they get to that terminal? And what is the trade that people should be thinking about, investors would be apt to consider in either of those scenarios?
Sure. If I was Fed Chairman Powell for a day, which I'm glad I'm not, there's a lot of pressure. A lot of people are, overanalyzing everything that he does. But I would say we should go 50 up front. And the reason is somewhat simple. If you look at where the Fed expected unemployment to be at 4.2%, that's where they expected things to be next year. At the end of next year, we're already there. And at the same time, we can argue about this hypothetical neutral rate for the Fed funds rate. We can say it's, the Fed said more recently it's at 2.8%. But let's say it's at 3.5%. Today, we're above 5% in the Fed funds. By any metric, our view is that's restrictive. So why not kind of front load it and kind of say we've had these big benchmark revisions to employment. Inflation is moving towards the 2% target. Get that one out of the way, and that will give them more optionality to watch the data and still be somewhat restrictive. So we think to answer your first part of your question is that we would prefer them to go 50. As far as who would benefit more, at least on a short-term basis, I think a lot of the areas that you've actually seen some better activity recently, small caps, they have more floating rate debt. You're seeing home builders break out more recently as well. You saw mortgage refinance activity starting to pick up as well. So the way to think about it, Brad, is really those companies that have more debt and are more leveraged to interest rates in some ways, at least on a short-term basis, would benefit more. Lastly, I do still think, though, the economy will matter on the sustainability of some of those kind of initial knee-jerk reactions.
Keith, I know you see money going back into tech for the fourth quarter. What's going to be the catalyst for that? Is it Fed cuts or something else?
Yeah, I don't necessarily think it's Fed cuts. I think partly is that the earnings momentum is still with tech. And I think what's happened really in July or heading into July, I think just got overextended, positioning overdone. So what you've really been seeing the last maybe month or two is really kind of getting some of that excess sentiment kind of wrung out from the sector. So I think that process likely has a bit further to go. So I think it's simply as we get into the earnings season and you see in a cooling economy, tech on the earnings front still outperforms. And I think that will drive investors back to tech, because I still think that's the part of this bull market. There's always a story. AI is still the story. If we think the bull market's intact, we think that's still likely intact as well.
All right, Keith, always great insights and perspective. We know you're going to be sitting on the edge of your ergonomic chair like we will be at 2 p.m. for the decision, and 2:30, hinging on every word that Fed Chair Powell has to say. Keith Lerner of Truist, thanks so much.
Thank you.
Certainly. We've got all your markets action ahead. Stay tuned. You're watching The Morning Brief. All eyes are on the Fed decision this afternoon, 2 p.m. Eastern Time. Our next guest thinks too much focus is being put on the Fed and it might be time to reform the central bank. To discuss, we have Judy Shelton, Independent Institute Senior Fellow and author. Judy, good to have you here with us on the program this morning. Okay, so what type of reform then would you like to see at the Fed, especially on not even the eve, the day of some of the big decisions that they're making and are set to announce later on today?
Well, I think the reforms I would like to see have to do with the mechanism that the Fed uses to implement its monetary policy decisions. When the Fed talks about going from the current rate of 5.4% to 25 or 50 basis points lower, what they're really talking about doing is deciding whether they should keep paying commercial banks and money market mutual funds that very generous rate, 5.4%, that they have been staying at for quite some time, to keep their money sitting idle in cash depository accounts at the Federal Reserve. The Fed created so much liquidity when it was trying to stimulate the economy that now it has a problem of needing to corral those funds because they could be inflationary. So now the Fed is paying about $200 billion a year since they started raising. That was 11 and a half decisions ago. They in March 2022 started paying the amount that they would give to these commercial institutions not to make loans. They've given them over $500 billion. Mm-hmm. So that's real money. And I think that it's kind of like paying farmers not to grow crops or paying people not to work. I would much rather they went back to the old way that Paul Volcker did of engaging with the market through open market operations. This is just an administered rate that the Fed committee decides. And I think it's kind of demoralizing. And it keeps that vital financial capital from reaching the real economy.
Judy, I'm looking at your recent article here in The Sun, and I'm curious, why do you think that Musk is the right person, Elon Musk is the right person for the job that you're describing here?
Well, I think the idea of an efficiency commission is pretty good. I tend to think that the problem with our deficit is a matter of the government spending too much. And I think that understandably during COVID, a lot of programs were started in a hurry. And I think there are substantial cases of fraud. And I would like someone who has a pretty good eye for figuring out how to run more efficiently to take a look. He seems to be a willing candidate. He'd work for free. And I think he would be pretty good at spotting excess government spending in ways that taxpayers would approve and say, look, we're all for legitimate fiscal transfers to people with disabilities or unemployment insurance, but we don't like people to take advantage of those programs. So I think there's a lot of money to be recaptured by taking a closer look at those things. And the fact that the Fed, only since September of 2022, turned into a losing operation insofar as they have to spend more to pay off those banks and money market mutual funds than they take in as interest on their own portfolio. So they've been running an operating loss that, as I say, is now over $500 billion. That deserves to be looked at because the Fed has other tools.
You know, it's so interesting, and on a few of the points that you were making, it's such an atypical event that everyone was responding to. I mean, Congress spends, the Fed lends, is especially what we hear so often. And so with that in mind, what would have been the delta had they not made those decisions? And now it seems like if we're able to avoid a hard recession or at least see a soft landing come through, then there's a lot of just check marks or a lot of, hey, job done. We can continue to figure out where on the dual mandate they might need to make adjustments in the future, but with inputs that have drastically changed, whether that be the population size because of immigration or whether that be because of the types of jobs and roles that have shifted in the wages, so forth as well. And so on the dual mandate side, is there an adjustment that needs to be more modernized in accordance with some of the reforms that you were discussing a moment ago?
Well, I think the most important part of the dual mandate is the mandate to foster stable prices. And the Fed has kind of turned that into something else. They don't mean stable prices. And I think that's more important, I would say, than the employment part, not because employment isn't very, very important, but that's not really the Fed's bailiwick. If you go on the Federal Reserve website, they will say, we don't set parameters. We don't say what we're trying to hit as far as an unemployment number, because those are more structural issues. But on stable prices, that should be what the Fed is seeking to do primarily. And by really seeking stable inflation instead, I think that they've resigned themselves to the steady debasement of the money unit, of the dollar. And I don't think there's a lot of wisdom in perpetual inflation as far as any economic benefit. I'm mentioning Paul Volcker now for the second time. In his last book called Keeping at It, The Quest for Sound Money and Good Government, he said that he never understood from an economic or a morality point of view why you would want to have any positive level of inflation, even 2 or 3%. He said, my mother would see through that. He thought there was no need to be skimming. And I do think that even low levels of inflation, think of after 10 years, you had a house, maybe the price went up 20%, but it really didn't change in actual value. And yet you would be required to pay capital gains tax on that nominal gain. So I think the Fed should get back to basics and even reevaluate its inflation target.
Yeah, and of course that would depend on Congress as well. But I do want to switch gears a little bit because you have previously advised former President Trump on his economic policies. And Trump has said about the Federal Reserve that he would be looking to have a pretty direct impact on the Fed's movement moving forward. Trump previously nominated you for a position in the Federal Reserve. If he were to put you in that position as Fed chair, if elected, how much input would you take from President Trump?
Well, I really hadn't thought about it. My interaction with him at the time, I saw him exactly once while he was president, and that was for my interview to be considered as a nominee to be a governor of the Federal Reserve, along with Chris Waller. And he couldn't have been more businesslike. He had my resume in front of him. He never asked me how I would vote or what my thinking would be as far as monetary policy. I certainly didn't get the sense that he thought he could influence that decision. I think he had a right as president, as I think every citizen has a right, to disagree with some of the things the Fed was doing. In fact, at the time, his big complaint about Chair Powell was that the Federal Reserve was raising interest rates even though we had record low unemployment, which was especially helpful for minorities. We'd never seen historically such broad participation levels in having jobs. And there was no sign of inflation. It was well below the 2% target, but the Fed was preemptively raising rates. And his complaint was, why are you unnecessarily curtailing growth when there's no inflation present? And it did cause the Fed to reevaluate their framework for deciding when to raise rates.
And so with that in mind, if we did see a Trump presidency, he's already said that he would like to have a say, and you've been adamant about the Fed continuing to remain apolitical. Should the president have a say in operations of the Fed?
Well, the way it's set up, I guess you could say maybe Powell should never have met with Trump, and yet he did. I guess you could say that Chair Powell shouldn't meet with the Treasury Secretary, who happened to have formerly been the chair of the Fed, or perhaps President Biden shouldn't have Lael Brainerd, the head of his National Economic Council, who was the vice chair of the Fed, meet regularly with the Fed chairman, but they do. And the Fed chairman meets with all members of Congress. I suppose you could say he's not allowed to read
yes
the opinion.
or no, should the president have an impact on Fed policy?
Well, I think that if you think that he's dictating it or somehow telling the 19 people who participate in those meetings how to vote, I think you're sort of underestimating everyone's ability to be responsible for their own decision. So I'm not sure, should he weigh in? Should he have a vote? I mean, you'd have to restructure the Fed. And as you know, that's up to Congress. They're in charge, according to the Constitution, of regulating the money.
Judy, we got to leave the conversation there as we're pressing up against the end of the hour. Judy Shelton, Independent Institute Senior Fellow and author. Thanks for taking some time here with us today.
My pleasure. Thank you.
Thanks. We've got all your markets action ahead. Stay tuned. You're watching the Morning Brief. Let's do a check of the markets 30 minutes into trading as we're taking a look at the Dow, the S&P 500, and the Nasdaq. We've got some mixed activity as of right now. We're, of course, a few hours away from that key Fed decision here. The Dow and the S&P 500 in the red, the S&P 500 flat, just barely to the downside. The Dow down by about 0.25%. Nasdaq, tech-heavy average, holding on to gains. And technology, one of these sectors leading the pack. Technology is up, real estate's up, but pulling up the caboose, financials right now, Maddie.
All right, coming up, rate cuts could be major catalysts for the bond market, commodities, the housing market, the broader market, guys. It's a big day, so we're going to speak to experts across the next hour about what to expect. Stick with us for Catalyst.
Welcome to Catalyst, everyone. I'm Brad Smith alongside Madison Mills. We're 30 minutes into the trading day. A big catalyst moving the markets today. Must be that looming Fed decision. So let's dive right into what we're watching.
That's right. The big question ahead of today's decision, is it going to be 25 or 50? Markets pricing in 50 basis points of cuts. We'll dive into how the size of that cut could impact market action.
And new home construction jumping, as Destiny's Child would say in the latest data as mortgage applications continue to rise. The housing market has been a drag the last 2 quarters. So could rate cuts be the inflection point that turns things around? We'll get an analyst reaction later on in the hour.
That's right. Plus, we've got big moves in commodities. Gold and silver continuing to move to the upside on the heels of that Fed decision. And then we've got oil falling. We'll tell you what this signals about the health of our economy.
But first, let's check in on the bond market. Treasury yields rising as a recent economic data and commentary from Fed experts have traders pricing in a 50 basis point rate cut. We have Ruben Hovhannissian, who is the generalist portfolio manager at TCW in the fixed income group there. Ruben, great to have you here with us today. All right, so just walk us through some of the thought process from the fixed income side now that we're ahead of and really just staring down this impending Fed rate cut anticipated decision to come at 2 p.m.
Great. Good morning. Thanks for having me on. So as you mentioned, the market is pricing in about 60 to 70% probability of 50 basis point cut. So 25 basis point is a foregone conclusion. So it's going to be at least 25 and maybe 50 basis points. Typically, the Fed doesn't like to surprise the markets, and that probability has gone up over the last week or so to 60, 70 basis percent, and the Fed hasn't really pushed back. So it's very likely that they move 50 basis points. We at TCW believe that at least 50 basis points would be warranted. We would actually argue for more because the economic growth is slowing, and we think that the super restrictive monetary policy that we currently are in is not helping the economic growth. So we would, obviously the Fed is not going to do more than 50, but we think, more than 50 would be warranted. And if the Fed does less, then that means that the Fed cuts will be larger and faster than the market is pricing in on a go-forward basis.
Do you think the Fed is already behind here?
We do think the Fed is behind the curve. There are clear signs that the economic growth is and has been slowing. You look at the labor market, you look at the consumer, weakness. You look at the net credit creation in the economy, which is very, very low. You look at any other indicators, especially forward-looking indicators, and they would suggest that the economy has started slowing significantly, starting from in the first half of the year. And we think as we go, as the rest of the year unfolds and we get in 2024, we'll see a more pronounced slowdown in economic growth.
Okay, and so what does that slowdown look like, and what is the Fed reaction that you anticipate will continue to come as that slowdown plays out?
So the slowdown, let's look at labor market, for example. I mean, there are some forward-looking indicators of labor market weakness that have been flashing at least yellow or orange for a long time, such as, quits rates, job openings rates, temporary help services. A lot of reliable forward-looking indicators as opposed to lagging indicators such as unemployment rate. I think this cycle has been unique in that the recovery has been associated or accompanied by a super tight labor market. So the initial phase of labor market slowdown didn't really register in unemployment rate because the labor supply was still higher than labor demand. The labor demand was still higher than labor supply. And the initial phase was labor demand coming down, but still being above labor supply. So it didn't impact unemployment that much. But if you look at a broader measure of unemployment, for example, the one that's called U6, and the Bureau of Labor Statistics calls it it includes the unemployed, and it also includes people who are working part-time for economic reasons, people who are discouraged people, and other people who Bureau of Labor Statistics calls marginally attached to the labor force. That measure is up by about 1.5% from late 2022 and early 2023. So we think the further slowdown in the economy and further decline in labor demand will be accompanied by rising unemployment rate, which is sort of we've seen in the last couple of months, and we think that will continue.
Yeah, Ruben, I'm so glad you bring up U6, by the way. That's my personal favorite economic indicator. So 1,000 points for you for coming on with that. Appreciate it. But I am curious, before we let you go, if we can talk a little bit more directly about the yield curve in the bond market. If the Fed does not validate the market's pricing of a 50 basis point cut today, what's going to happen specifically to the long end of the curve? Are we going to get a rally that starts to price in a potential policy error, or maybe a sell-off that starts to price out rate cuts after having priced them in too much?
Well, I don't think, well, in addition to the cuts themselves, there's also the press conference that's going to start half an hour after the announcement. So the Fed will have an opportunity to refine their, provide some qualitative comments as well. And we're going to get the dot plot, we'll get the economic projections, and we'll see what they look like. But generally speaking, we think the Fed has made it clear in August, since August at least, when Chairman Powell said that the time has come to adjust the monetary policy, and they've told us that they do think that the risks to labor market are now as large, if not larger, than the risks to inflation, and we think that's a signal. So we think even if it's 25 basis points cut, they'll probably come out with some dovish statements that will provide qualitatively indicate that they're inclined to do more. Which is what they've been telling us.
All right, we are on hourly wait-and-see mode as of this point right now until that critical 2 p.m. marker here. Ruben Hovhannissian, who is the generalist portfolio manager in the fixed income group at TCW. Ruben, thanks so much for taking the time.
Thanks for having me on.
Certainly.
And stay with Yahoo Finance for that decision out at 2 p.m. Eastern, followed by Fed Chair Powell's presser at 2:30. Yahoo Finance will bring you coverage of today's meeting starting at 2 p.m. on the dot. Well, we're going to check in on the moves that we're seeing in the commodities market ahead of that decision. Our very own Inez Ferre is at our touch screen with the latest moves. Hey, Inez.
Hey, Madison, and let's check out oil and also the metals. So let's start off with West Texas Intermediate and Brent crude, which has been rebounding in recent days, but today we are seeing a little bit of a pullback, just basically flat. Brent crude also flat. You have seen the rebound because of the disruption in the Gulf Coast because of Hurricane Francine. Also some escalating geopolitical tensions in the Middle East. Oil may take a cue this afternoon after that Fed meeting, specifically around the tone of Jay Powell's comments. Whether it's a 25 basis point cut or a 50 basis point cut, a more concerned Fed could lead to some speculation over demand in the future. And moving on to gold, we have seen gold futures at this 2,600 level. This is about the resistance that we have been seeing for gold. Goldman Sachs had a note out recently showing that changes in interest rates do continue to lead to changes in gold prices. An analyst at that firm reaffirming their long gold trading recommendation with a price target of 2,700 by early 2025. But take note that that's one of the more conservative views because you have other firms calling for 2,900 by the end of the year. Year to date, we are seeing gold futures that are up 26%. A lot of this is due to that central bank demand, a boost from interest rate cuts, also a lower dollar, geopolitical and recessionary risks. All of this has been contributing to the rally that we have been seeing in gold. So the expectations of a rate cut today also being priced in there as well. But we may see a move with gold today after that rate cut announcement, expected rate cut announcement. And then with silver, I just want to point out, you saw gold that was up year to date. Silver is up even more year to date, up 30%. It's at around just above the $30 level. It had gone just past the $31. So we will see if silver can push up a little bit more also today, this afternoon, after that Fed decision, guys.
Inez, thanks so much. Tracking all of the commodities here ahead of that Fed decision. We're also taking a closer look at Yahoo Finance's trending tickers. 3 names to watch. We've got Tupperware, we've got Stellantis, and 23andMe. We're doing it in less than 30 seconds each. So let's go. Let's give it a shot. First up, Tupperware. You can see shares plummeting since its IPO, but specifically more recently here, the company filed for Chapter 11 bankruptcy on Tuesday following years of financial troubles. In a statement, Tupperware president and CEO said the last several years have been challenging due to the macroeconomic environment here. And there is the max chart that you're seeing on the screen. There have been highs, there have been lows, but more recently and over the stretch of the last several years here, some significant declines. They say over the last several years, the company's financial position severely impacted by the challenging macro environment. And this is one of the strategic options that they've explored. Ultimately, this is not meaning that the company is dead, but bankruptcy, and we'll see if they are able to emerge from it as well.
Yeah, certainly a tough couple of years for Tupperware there. All right, but we are also watching Stellantis, the company now facing the threat of a United Auto Workers strike. UAW President Shawn Fain saying in a speech last night that the group plans to hold strike authorization votes against the automaker. He says the maker of Jeeps, Chrysler, and Dodge is not meeting the guarantees of last year's contract, and that was again the 2023 agreement here. So the accusation, the allegation here is that the company has failed to live up to those 2023 commitments. Stellantis, for their part, still struggling with a huge lot of unsold cars, Brad.
All right, let's also take a look at 23andMe. All 7 independent directors resigned from the company's board after its CEO shared an unsatisfactory buyout plan here. The shares right now, they are higher by about 2.5%. What you need to know, though, is that they've said, at least in the directors, sending a letter to the company's co-founder and CEO, after months of work, we have yet to receive from you a fully financed, fully diligenced, actionable proposal that is in the best interests of the non-affiliated shareholders here. The CEO, Anne Wojcicki, has essentially been trying to figure out how to turn this company around, but those have been some flailing efforts as of recent.
Yeah, really quickly, I want to mention this company has been on a tough ride over the past year. They had a data breach, millions of customers' data leaked and utilized for things like anti-Semitic purposes, among other issues there. They also were at risk of being delisted from the New York Stock Exchange because of the degree of downward pressure on the stock price. So really a tough year, not only for 23andMe, but also CEO Anne Wojcicki is continuing with this issue with the board of directors. I also do want to mention a programming note. You can join us as our markets editor, Jared Blickery, sits down with A-list strategists to decode the day's market moves. From word of the day to who wore it better, this is Yahoo Finance in its best form. I personally love this podcast, Stocks in Translation. It airs every Tuesday and Thursday at 8:30 a.m. Eastern. So please mark your calendars for that. Set those alerts on your phone and stick with us right here on Yahoo Finance because you're watching Catalysts.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Let's begin by taking a look at shares of CRM, Salesforce. Taking a look at a fractional movement lower as of right now. The company acknowledging at its annual Dreamforce conference this week that its generative AI strategy could contribute to future job losses. Our own Brian Sazi, he caught up with Salesforce CEO Mark Benioff at the conference and was able to ask him about the state of AI regulation and safety in the United States.
Are regulators able to, how far behind are they? This is election season, and we're not going to go down that route, but I'm getting images and photos on my social media accounts that I don't know if they're the candidates. I don't even know who they are, where they're being created from. It just feels like AI in that case is being used for bad.
The European regulators have been super impressive. I've been very impressed with the EU regulators and the Competition Market Authority as really leading the world in this area. I even went to the UK safety conference. That was the most impressive one I went to. We have a great leader in this country who's coming here for an interview with me tomorrow, Senator Mayorkas. I hope you'll come to the interview because he has led the pioneering way on looking at AI safety in the United States as our chief, by the way, our chief cop, right? He runs all of our most important security agencies. And it's impressive that he is also leading the AI safety program.
Do they feel behind? Are the guardrails being put in place?
I think that we are doing a lot of the right things, but we don't know necessarily what the wrong things are because the future is still somewhat undetermined.
And now, of course, there has been a larger battle in some of the CRM or ERP landscape here as we've been watching all of the deal flow start to come through, and not just on deal for portfolio clients, but strategic partnerships. And Salesforce certainly a part of those as well. Salesforce and NVIDIA, they put together a strategic collaboration to advance AI agent innovation. You also had Salesforce and Google Cloud. They say joining forces to deliver autonomous AI agents here that could collaborate across Salesforce and Google Workspace here. And this is perhaps not the first time you've heard about Agentforce. Salesforce talked about that within their most recent earnings results. But Salesforce is not alone within this landscape as not just talk, but delivery of some of the prompt and output that is going to be leveraged based on large data sets. Oracle, one of those other major winners, at least in the software or cloud landscape in this near-term period of time. And the stock has certainly shown and reflected that as of recent here. So we'll see what more comes from Salesforce during its conference that our own Brian Sazi, you saw him out there at.
Yeah, it's also interesting to note that Governor Newsom signed a bill at Dreamforce to combat deepfake content regarding the election, which is, of course, what Sazi was talking about in the beginning of that interview, saying that he has seen a lot of content on his own social media feeds that indicates, fake content, right? This idea that it is AI-powered deepfakes. And I thought it was interesting that Benioff kind of said, oh, well, globally they're working on it. Okay, well, what are we doing here? This is where, a lot of our users are, certainly where they were having the conversation. So something interesting to note moving forward. And to your exact point, Brad, I think the partnerships that a lot of these companies, not just Salesforce and NVIDIA, but also last week I talked a lot about Amazon partnering with Oracle, a history of huge competition between the two. Yeah. We are starting to see these tech giants coming together, all love in the game of tech.
Absolutely. Well, look, I can't wait to hear about more from coming from Dreamforce here. Mm-hmm. Programming note, you on the hunt, perhaps, for the hottest market commentary? Watch Opening Bid. Yahoo Finance's executive editor, Brian Sazi, for unrivaled insights from top analysts and direct lines to the biggest power brokers in business. Tune in every Monday, Wednesday, Friday, 8:30 a.m. Eastern Time. He must have written that tease. I don't feel like I did it justice, but it was a good one right there.
I loved it. I thought you crushed it, Brad, as always. We're going to switch gears a little bit, though, taking a look at pharmaceuticals. The race to scale weight loss drugs and increase affordability of those drugs continues. Joining us with the details, we got our very own Anjali Kemlani. And Anj, there's a lot of news when it comes to pricing of these drugs. What is top of mind for you in your reporting here?
Yeah, right now I'm actually focused on next week. On Tuesday, we're going to see Novo Nordisk CEO Lars Jorgensen join Senator Bernie Sanders for what will be a much awaited showdown. Definitely he's going to get grilled on the pricing, and we're going to have a chance to listen to him talk to lawmakers, and that is the CEO, talk to lawmakers, including Bernie Sanders, who we know has been really adamant on the idea that these drugs can be sold for lower. We know that Senator Sanders did meet with some pharma executives talking about the fact that the generic versions could be sold at a 90% decrease from the branded prices. And of course, generics will undoubtedly be cheaper, but when do they get on the market? We know that Ozempic, for a fact, will only face generic competition by 2031. That's the earliest that it is set to face competition, even though some parts of the patent for the drug have already expired. So it's been building up. We also know that the company has expected to be on CMS's negotiation price list for some time. Since as early as March 2023, we've heard hints in their earnings calls that they have taken for granted the fact that they will be on the list at some point. So whether it's Ozempic by brand or the semaglutide, the drug ingredient that's going to be on the list, that's one of the things that we're kind of following, which is, looking at whether or not they will end up on this drug 2027 or 2028, in fact, is one of the things that we've seen. We heard EVP Doug Langa, who is in charge of North America operations, sort of casually throw out there, they're doing this in 2027. It does appear that CMS will be implementing a molecule. So that's something that we're keeping an eye on. We also know that Novo has said that it has already dropped the price of Ozempic by 40% since it launched in 2017. Now, that may be true from the launch price. We did notice a slight uptick from $935 per month to $968 per month in the most recent year or so, in the last year or so. That has been a slight uptick. So it'll be interesting to see how that all goes through when it comes to facing Senator Sanders next week.
And so when it comes to delivery of these drugs, what about pills?
Yeah, pills is really the next frontier, honestly. That is where the competition is heating up. We got a number of updates from drug companies like Roche as well as Novo Nordisk last week, promising early stage results. Now, Lilly is way ahead in this category. It has already set the bar with the weight loss standard at about 14% weight loss with the pills once daily. There's so many questions, though. Analysts are really waiting to see. And as you can see on your screen, these are the companies that are in that pill race right now. Roche had some interesting side effects, and that really pressured the stock last week. But it's not really different. GLP-1s have been known to have really strong nausea, vomiting, and dizziness as part of the side effects. And that's something that they saw that was concerning. And it's why analysts have pulled back a little bit. You're seeing notes everywhere talking about, caution and hesitation because of this. Some doctors have said this could be a way to maintain weight after using injectables. Some patients may prefer the weekly, monthly injectables rather than the pills. So the competition in the market itself is so uncertain right now that while it seems appealing, right, the idea of a daily pill versus a weekly injectable, there's still a lot of questions in the air on what that competitive market will look like, what the pricing, in fact, will look like, right? It's much cheaper to make pills than injectables. So a lot of questions up in the air still about that.
And certainly a market for cheaper options. When we had that chart up, that was wild. Just the degree of difference in U.S. pricing versus other companies. Countries rather. I know you've reported on that quite a bit, Anjali, but just to see it, horse of a different color. Really fascinating stuff. Yeah,
always.
Anjali, thank you so much. Really appreciate it. Thank you. Well, we're going to have all of your markets action ahead right here on Yahoo Finance, so stay tuned for more. It's Fed Day. Get excited. You're watching Catalyst. Woo! Investors bracing today for an uncharacteristically uncertain rate decision from the Federal Reserve. A week ago, Wall Street still pricing in an 86% chance that the central bank would lower its benchmark rate by just a quarter point. But as of this morning, those odds just stand at just under 40%, and the market sees a 50 basis point cut as much more likely. So what happened in the last week to tip the scales here so significantly? Reports from both the Wall Street Journal and the Financial Times triggered the shift.
Yeah, the heavily sourced Journal report that you mentioned, Maddie, cited John Faust, the former senior advisor to Powell, who acknowledged a 50 basis point cut could be scary for markets, but Powell could soothe concerns with his commentary. In the days that followed, former Federal Reserve members, including Bill Dudley, validated the view that the Fed should go for 50. With that confirmation, the market repriced the degree of cuts. On Monday, we spoke with Claudia Sahm, chief economist for New Century Advisors, and she acknowledged a half-point reduction could come as a shock, but that shouldn't deter the Fed from making it.
I think it's important how it's communicated, and I expect, and I think, everything in the setup you've talked about, Wednesday afternoon is going to be a little bit of a bumpy ride, right? There is a lot of uncertainty, but it's not like the Fed has created drama just to create drama. This is legitimately a difficult decision to make, and they've got to stick to the economics of it and not get into the psychology. That piece will work out if they make the right decision about the rates.
So markets momentum has continued to surge in the days leading up to the FOMC's decision. The S&P 500 has advanced for 7 straight sessions, up more than 4%. And depending upon how today's move is received, recent market gains could be in for a bit of a reality check.
Yeah, and it's not just today's cut that could rattle investors. Fed Chair Powell's conference following that decision will be closely watched for any indication of how officials are thinking about cuts moving forward. So we will certainly all be heavily tuned into that conversation. Well, we're also going to switch gears just a touch because the number of new residential builds ticked up in August as mortgage rates continue to trend down from multi-year highs. The Federal Reserve is expected to cut its benchmark rate in just a few hours, a move that many anticipate could benefit the historically tight housing market. We've got Rafe Jadrosich, BofA Securities Senior Home Builders and Building Products Analyst, joining us now to discuss. Rafe, it's great to speak with you. I want to pull up a chart because we are already seeing a record in refinancing applications at their highest levels since, I believe, 2022. You can see at the end of that chart, you are getting an uptick at the very end in those refinancing applications. Rafe, what does that tell you, given that we haven't even had the Fed cut just yet, and we're already seeing people running to refinance?
Yeah, but first, thank you for having me. If you look at the mortgage rates over the last 3 months, from the beginning of July to today, we've seen mortgage rates fall from around 7% for a 30-year fixed mortgage down to almost 6.1%. That's a really sharp decline in a short period of time, which is driving the increase in the refinancing activity. And we're almost at the lowest mortgage rate in over 2 years. So in anticipation of the Fed rate cuts, you've seen the 10-year Treasury yield fall, and then mortgage rates have come down along with that.
Where do you believe, and as we're taking a look at the mortgage rates, the 30 and the 15-year, that have tremendously kind of not dropped, but they've trickled lower over the past several weeks, months here as we've been tracking that. And so with that in mind, what is the real mortgage rate going to need to look like for people to come off the sidelines and into the housing market in droves?
Sure. So if you look at the current homeowners right now in the market, there still is a lock-in effect. So the average mortgage rate today for homeowners is 3.9%, still a pretty big gap in the existing home market. From a new home perspective, we've already started to see an uptick in demand in August relative to June and July as rates have moved lower. We think something in the range of, when you get to something with a 5 handle on it, you'll start to get a little bit more activity on the existing home sales side. There has been an uptick in inventory, which is part of the solution or part of the process for existing home sales to uptick. So we still have a lock-in effect, but definitely as you're going forward here, it's gotten a little bit better.
I want to get your response to a conversation that we had yesterday, because we spoke with Middleburg Community's chief economist, Brad Case, about the biggest issues facing the housing market. He says it's going to take much more than a rate cut to solve those problems. I want to get your take on the other side.
The basic problem with single-family owner-occupied housing is just that it's way too expensive. It is overvalued to the extent that it was back in 2006 before house prices crashed. And so the essential problem is that people don't want to take a highly levered investment in an asset whose price may come down sharply.
So, Rafe, I'm curious, if the problem is pricing, then what are rate cuts going to do? Are rate cuts going to significantly impact housing prices in one direction or the other?
Sure. So there's sort of a story of two different housing markets right now. You have the resale market, the existing home market, and then you have the new home market. There's a really interesting dynamic in pricing where existing home prices are actually above new home prices. If I look at that historically, on average, new home prices are around 20% above the existing home market. And I think this is just a dynamic of supply. New home builders are adding supply to the market. They're building new homes. We saw the starts uptick today versus existing homeowners who they're locked in at a really attractive rate. So in order for them to sell their house, they want to be compensated for giving up their rate. Now, lower rates will help solve the affordability problem just because financing costs are lower. Although prices probably tick up a little bit. We think obviously lower rates will support pricing. We just need more inventory on the market as well. We're still well below the 2019 level of inventory on the market. Lower rates will help increase what's available.
And so with the increase of inventory that we do need, who are some of your favorite home builders that you're tracking right now?
Sure. So if you look at prior periods of rate cuts, the best performing home builder on a relative basis has been NVR. We also like the housing markets that they're in. The Mid-Atlantic is a really strong performing housing market. They have the highest market share there. And then on the entry level side, the builder that we think potentially has the strongest sales uptick from lower rates would be D.R. Horton, the largest builder in the U.S. They've made some really positive changes to their capital allocation over the last quarter. We expect the free cash flow to improve. They're buying back a lot more stock. So those would be two that we would highlight.
Rafe Jadrosich, who is the B of A, Bank of America, Securities, Senior Home Builders and Building Products Analyst. Great to have you here with us today, Rafe. Appreciate it.
Great. Thank you.
Thanks. Maddie, on over to you.
Thanks, Brad. So I want to pull up our chart of the day because I am watching record leveraged bets ahead of the key FOMC decision that we've got today. Behind me here, you can see activity in October Fed funds futures. It has jumped to the most extreme level of any such contract since the derivative was created, and that was back in 1988, just to give you a sense of the scope of the degree of these bets. Now, the bulk of these new bets are targeting an outsized half-point cut. So you can see here just the uptick that we've seen in these levered bets, particularly over the last couple of sessions here. Since Friday, we've seen the majority of this activity when it comes to futures contracts. Now, the reason that this matters, and the reason I'm pulling this up, right, is because this is a market that is kind of potentially at risk of being caught offsides, right? There's a chance that we have over-levered, not just in a derivative like this one, but also in the yields space, in the bond market, and of course in equities as well. We have seen a degree of repricing of that 50 basis point cut that is really historic in terms of the degree to which we have not necessarily seen this much market repricing as fast as we've seen it over the past couple of sessions ahead of a potential Fed rate cut. This leaves the market open to a lot of vulnerability heading into that Fed decision today, particularly as we do not necessarily know if Powell's potential interest in a 50 basis point cut is going to be enough to sway the rest of the voting members. There is kind of this idea that's a little bit of a conspiracy theory out there on the street that Powell has been working behind the scenes to try and convince his fellow members to go for 50. But today is when we're going to find that out, and whether we're going to find out if the folks who are heavily levered here in the Fed fund futures market are going to be potentially caught offsides here, Brad.
All right, all of this is going to come into focus as it already has been, but really comes to a head at 2:30 p.m. 2:30 when we start to hear from Fed Chair Powell. Thanks so much, Maddie. All your markets action ahead. Stay tuned. You're watching Catalyst. With the first rate cut in 4 years expected to be announced later this afternoon, as well as a monumental presidential election less than 2 months away, there's lots of questions about which direction the economy will be heading in 2025. So how are America's top CEOs feeling about the state of their companies and the economy as a whole? A new U.S. CEO Outlook survey from KPMG helping shed light on these questions. Here to discuss, we've got Paul Knopp, who is the KPMG CEO, joining us here in studio. Great to see you once again, Paul.
Great to be back.
Absolutely. I mean, just take us into the pulse of CEOs right now and how they're ranking some of these very serious events that are coming forward eminently today with the Fed, and then, of course, in a couple months with the presidential election as well. What is their prioritization right now?
Well, certainly we're watching things like geopolitical complexity, and that's been obvious for some time now. Economic uncertainty, political uncertainty. But amazingly, CEOs are very optimistic about the next 3 years. Upwards of 80% of CEOs are really optimistic about their growth outlook. And I think that's because we've been navigating all kinds of uncertainty the last 4 years and doing it with excellence. And now we have some clarity on the direction of interest rates and inflation cooling somewhat, and I think that's giving CEOs some confidence that we can absolutely deal with this environment, and it's going to be interesting to see how it all plays out.
It makes me wonder about some of the challenges that we have seen, and certainly the Fed has seen in the labor market, this idea of just tightening up a touch, not necessarily huge layoffs, but we're not hiring, maybe some attrition. What did you hear from CEOs about the path forward for hiring?
Well, it's a very dynamic labor market. Of concern is the aging workforce. Of concern, too, is less students going from high school to college. And so we expect that labor force to remain somewhat imbalanced and somewhat tight. And talent is a big concern for CEOs right now. They want to make sure they have the right talent in the right places moving forward into the future, particularly with upskilling and reskilling of talent around generative AI and AI. So there's definitely all that at play right now. And we're trying just to make sure that we have the right talent to sustain great business operations for years into the future.
We've increasingly heard from CEOs, and in an election year that is expected to be extremely vitriolic, we heard from CEOs about that last year. And so all of this in mind, 2 months away, what are CEOs, from what you're discussing with them, what are they gaming out right now, and an outcome perhaps that they're trying to best position their company for?
Sure. So scenario planning is at a premium right now in terms of making sure that you're ready for anything. And we as business leaders believe that we can deal with whatever environment we have, whatever outcome that we might have moving forward into the future. And we're definitely making sure that we're ready for whatever might happen. And that includes positioning, tax positioning, running scenarios on what the tax outlook might be beyond 2025 when the TCJA expires, if it does expire, or if they actually put a new law into effect or renew them. So every scenario has to be imagined right now, and just trying to prepare for what's going to be reality in 2025. It's really important too to mention that with all the geopolitical complexity, CEOs are also very concerned about their supply chains and making sure that they are ready for anything, as well as embedding and embracing generative AI into their businesses. That is top of mind for many CEOs. It's one of the biggest challenges they have right now.
And just to add to the laundry list of challenges, when you talk supply chain, something that pops to my head immediately is cyber attacks and the potential risk with cybersecurity. Certainly a huge issue that we've seen companies dealing with over the past couple of years. How concerned are CEOs about that, and what are they doing to hedge the risks? Yeah,
so they're very concerned about it. It was one of the top risks in our study this year. You know, the reason they're concerned about it is the nature of the risk keeps evolving. With generative AI and AI now, there are deep fakes that you can produce quite easily, and quite sophisticated deep fakes. So that's what concerns us, is that these things keep evolving. We have to have amazing awareness of what's happening to make sure that our employees and all of us do not get caught up in cyber crime. And so it's really important to make sure that you have preventative measures in place, as well as the detective measures we've historically had. But the technology that's out there right now is really great, but at the end of the day, it's really about awareness of the risk.
And I also don't want to let you go before we get to some individual company news. We heard from Amazon telling workers to get back in the office 5 days a week. Some of the sources that I've spoken to about this story feel like that is attrition hidden in a return to office message, that they're hoping that folks will end up leaving the company. What are you hearing from CEOs about how they are thinking about the return to office, and if they're thinking of it as a potential tool for protecting their balance sheets and bringing down some of their labor costs?
So our study revealed that almost 80% of CEOs, the sentiment is for back to office more like pre-pandemic in the next 3 years. And I emphasize that word sentiment because right now we still have a lot of hybrid environments, including our own environment at KPMG, which is hybrid. So I've seen a lot of experimentation and pivoting over the last few years. It's very much a sector and or company story. So every company is going to be a little different. In our industry, I believe that hybrid is probably here to stay. And so I really can't speak for any specific company in terms of what their motivations might be or what they're thinking. But what I can tell you is that you'll continue to see a lot of diversity in work environments moving forward into the future. Hybrid has worked quite well for many organizations. At the same time, we have to all recognize that we need our employees back together enough for them to learn, to ideate, to collaborate, to be mentored, to develop. And that's a fine balance to walk because the hybrid environment is a much more complex environment to optimize than the other two environments, fully remote or fully back at the office, which are more straightforward. So we're still hard at work trying to make sure that we have the absolute right environment to help our employees succeed, at the same time help our organization succeed.
All right, well, Paul, really amazing stuff. I mean, just so much intel in this report when it comes to not just attrition, RTO, AI, cybersecurity, geopolitical, just all of the good stuff that we love to talk about all the time. So really appreciate you.
Thank you for having me today. Appreciate it.
Thank you so much. That was Paul Knopp with KPMG as their CEO. Well, coming up, we're going to have all of your markets action ahead right here on Yahoo Finance. So stay tuned for more. You're watching Catalysts. Appetite for private credit is growing. 61% of fund limited partners reported they'll expand their asset allocation to private credit this year. That's according to the S&P Global Market Intelligence Survey. Joining us now with more, we've got Michael Gross, co-founder of SLR Capital Partners. It's a boutique asset management firm focused on direct lending. Michael, it's great to have you in studio with us on the Super Bowl Sunday, that is Fed Day today. Talk to me about the impact of what we might see today on private credit, whether it's 25, whether it's 50. What does that do to private credit?
So we've been in a higher for longer interest rate environment for quite some time. And you've seen the beginning of the impact of that on levered companies that were constructed back in the zero interest rate environment when rates were zero and they were levered 6 or 7 times. That was just fine. But with rates gone from 0 to 5.5% quickly and stayed there for a while, it started to put pressure on levered companies' balance sheets. So the decline in rates will be a welcome respite. I'm not sure it's going to solve all the problems. We had an environment where basically a rising tide lifted all boats in credit and everyone did well. You're starting to see cracks in the system. You're starting to see the beginnings of defaults, increased PIK income that are going to lead to future defaults. I think rate decline will help, but it's not going to solve the problem.
And so will it be a vacuum of investor interest or just a kind of stalling out in this new term?
No, I think investor interest in private credit is here to stay. Okay. Because if you compare returns in private credit to liquid credit, they're better structured deals. And banks more and more are being pressured to get away and out of that business. So private credit is filling that void. So I think it's definitely here to stay. There's continued investor appetite. Just picking the right investors to invest with becomes more relevant.
Yeah, well, and it makes me wonder about the right investments as well within private credit. How might that change? Is the bar essentially going to become a little bit higher as we don't exit the golden age, but maybe some gas is let out of the steam there?
Yeah, I mean, look, the bar should always be high in private credit. We as private credit managers don't get paid to take risk. We're lenders, we're not equity investors. And so the bar is always high. That said, the bar is higher today than ever because we're late in the economic cycle. You're seeing increased pressure on companies. Companies aren't growing as quickly. And so we look as a manager for different ways to lend companies as opposed to just against their cash flows. We prefer to lend against hard assets, receivables, inventory, things that we can liquidate and turn to cash quickly that aren't dependent upon the economic environment for performance.
So in that sense, then, what kind of subcategory within private credit would perhaps be best positioned to outperform even within that asset type as we're looking at a potential environment where it could become harder to get insured for certain homes or other products otherwise? It could be harder to come across a loan that you become qualified more as some of the restrictions at least become a little bit more stringent. Where are the outperformers within this asset class?
So I think within private credit, the most vulnerable to rate decline is traditional cash flow lending companies to companies that are owned by leveraged buyout firms.
Yeah.
As rates decline, spreads will decline as well. There are other sectors within private credit where that's not the case. Things like factoring, equipment leasing, life science lending, which carry absolute returns of 12 to 15%. Now, granted, they didn't go up as much as cash flow lending during the rising interest rate environment because they already started so high. But by the same token, they're not going to come down. So we see real opportunity in continuing to lend to those companies and filling the void where the regional banks are being forced to exit. What we haven't talked about is that the fallout from last year's regional banking crisis is real and it's here to stay. More and more of these regional commercial banks are being forced to exit attractive business because their cost of capital is too high. So things like factoring, things like equipment leasing, which used to be their bread and butter, they're starting to walk away from and look at selling their portfolios and selling those businesses.
How is that impacting investment in private AI companies?
We don't really do that, and most private credit doesn't. Okay. That's more kind of early stage lending. There are people who do it. They're more looking at trying to take bets about where they're also going to get equity value and warrant value. To us, that's not really a credit business.
No, it sounds like then on the data center side, for the build out of some of those data centers and the construction of them.
So data centers are great because it's recurring revenue, it's real estate, you're lending against hard assets, you have tenants that you can count on day to day. We like that business at the right value.
Okay. Michael Gross, co-founder of SLR Capital Partners. Great to have you here on set with us.
Thanks for having me.
Thanks so much.
Thank you.
Let's switch gears here for a hot second. Elon Musk is threatening to sue the FAA for, quote, regulatory overreach. The FAA is proposing over $630,000 in fines for the aerospace company, alleging it broke launch requirements during 2 missions in 2023. SpaceX certainly has been ramping up the amount of missions that it's been launching year over year, whether that be in the suborbital realm or whether that be putting more of their Starlink into space and making sure that they're increasing connectivity. So from any type of exploration here, SpaceX is actually going to need to keep a good relationship with the FAA. This kind of runs counter to how much they had been relying on NASA, the FAA, and other government bodies to ensure that they had the green light necessary to continue to prove their use cases for reusable rockets and the amount of space exploration that they wanted to bring to fruition through a private form rather than a public sector government-initiated basis.
Absolutely. I mean, it is nice to know that the FAA is on top of controlling how people go into space. I find that a little bit soothing here. I want to pull up the FAA's statement about the incident. They talked about how SpaceX used an unapproved launch control room and failed to conduct a pre-launch poll, among other issues cited by the FDA, saying, quote, safety drives everything that we do at the FAA, including a legal responsibility for the safety oversight of companies with commercial space transportation licenses. So just the beginning of issues that are likely to come here.
Also, we're talking about a decacorn company in SpaceX. It's not like they don't have the money.
Yeah.
All right.
Well, maybe he's thinking I've got the money to sue them then. I mean, when you got that much money, you have a lot of potential options. Speaking of companies with a lot of money on their balance sheet, let's talk about Amazon. Amazon is raising the hourly pay for its warehouse workers by $1.50 to over $22 an hour. Amazon also adding a Prime membership to the employee benefits package. I think it's very important to note that the Prime membership was not previously a freebie for Amazon workers. You might anticipate that, but that is not the case. This average base wage increase for warehouse workers to $22 an hour, something that workers have been very vocal about over the past couple of years. We've certainly seen a slew of protests from Amazon workers here in New York, of course, in Seattle as well. And as we have the addition of AI, which is meant in some cases to keep workers safer in warehouses that can typically lead to a lot of incidents for workers, that is also, though, potentially something that could put a lot of these workers' jobs at risk. So I think this is just a reminder of more to come for asks from Amazon workers.
Yeah, I think for Amazon, it's trying to get ahead of any potential unionization efforts as well. Of course, this is a company that's been alleged with union busting in its own efforts before, and so trying to make sure that they are offering more money prior to any unionization efforts in any of the capacities. That is something that perhaps worker pay will stave off, but a question of for how long it will stave it off as well.
If they can keep a union away forever, I'll be shocked.
Yeah, well, yeah, exactly. And a reminder to our viewers that the decision is out at 2 p.m. Eastern Time from the Fed here today, followed by Chair Powell's press conference at 2:30 p.m. Yahoo Finance will bring you coverage of today's meeting starting at 2 p.m. Eastern Time.
And coming up, Wealth is dedicated to all your personal finance needs. Brad Smith, he's going to stick around with you right here for the next hour, so stay tuned.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks that you need to grow your money. Hey, on today's show, we're going to bring you the personal finance playbook for the Fed's first expected rate cut of the easing cycle. We'll explain what you need to know and do to maximize your money. So let's get into it. In just a couple of hours, the Fed is expected to cut rates for the first time in 4 years. For the next hour, we're tackling how that rate cut will impact you and your money. First, how savings rates will get trimmed after rate cuts take effect, directly affecting what's in your savings account. And how rate cuts might ease consumer debt and might even ignite a boost in borrowing. Speaking of borrowing, we're exploring how cuts will impact one of the biggest loans people take on, and that's mortgages, and how that will shape the broader housing market as a whole here. And then, pivoting to ETFs, we're diving deep into which ETFs might stand to benefit from rate cuts. So, we've got all that and much more coming up this episode. Let's dive in. First, now is a good time to evaluate where you keep your savings so you can take advantage of the looming Fed rate cut. Yahoo Finance personal finance editor Molly Moorhead is here now with the ways to maximize your interest earnings. Molly, what do we know?
So during this high interest rate era that we've been in, we've all been enjoying some good rates on our savings accounts and other products, and that's about to change. So that's kind of the downside of this expected rate cut. But that said, there's still places to put your money that you'll still make a little bit off of it every month, not your investments, but your liquid savings.
And so with that in mind, what specific products or accounts should people consider?
High yield savings accounts, which are usually online banks. They've been paying really nice rates for the last few years. That's going to start to come down, but they're still a really good place to keep your money. They're liquid, you can access your money easily, and you'll make a little bit of interest every month.
Yahoo Finance's own Molly Moorhead, Yahoo Finance personal finance editor. Molly, thanks so much for the time.
Thanks.
Certainly. Well, the rate cut, it's all believed to be coming, but the size of the cut, that's anyone's guess here. With the FOMC set to lower interest rates for the first time in 4 years, investors, they are nervous about what a cut would mean for markets and the broader economy. Here to break down the pros and cons, we've got Tony Zapparo, who is the Equity Set CEO. Tony, great to have you here with us in the studio.
Great to be here.
All right, so let's talk about this a little bit here. I mean, which camp are you in as of right now? 50, 25, and what do we ultimately want to see? What should we want to see?
Yeah, I think there's a little bit of a dichotomy in what I would want versus what I think is healthy and necessary.
Yeah.
I think could easily see a 50 basis point cut. Personally, I'm a little bit worried about the long-term health of the economy, loose monetary policy, and so for harder money, right, would love to see rates where they're at, but that means more pain, right? That means more unintended and unwanted consequences for the consumers, right? A lot of consumer debt going on, not able to refinance, right? You can feel the pinch, but the inflation that has occurred, going even down to 2%, it's still compounding. And so really, as a small business owner, entrepreneur, as a consumer, I want to see rate cuts because that's going to help boost and kind of want me to go out and borrow more money. But long term, I'm a little bit worried about the debt ceiling, the fiscal responsibility, the fiat currency, and what that's going to do to the dollar and inevitably refinancing down the road.
I mean, what is the most notable way that rate cuts would impact people's finances right now?
Yeah, and so consumer debt is at all-time highs. Savings rate for them has ticked lower the last 6 quarters, which you really haven't seen for about almost 20 years. And so it could help, whether it's mortgages, right, help them refinance if they got caught in a higher 6-7% rate, and just simpler things, right, even car loans. A couple months ago, right, went and always curious to kind of see where things are at, and they were high, right? If you're not getting a new car, used car loans, 9, 10, 11, 12%. And so while if it's only a 25-point basis cut, right, it's ticking down a little, but it's going to help kind of alleviate some of that pressure, which could be $50, $100 a month in savings for customers.
And so with that in mind, let's think a little bit more about where, for investors out there, they should be positioning their portfolio in the rate cut playbook mindset here.
The interesting thing is traditionally, if you go back about 20, 30 years, when rates are being cut in the face of rising unemployment, it spells disaster for the markets. And it's flips it a little bit on its head because it's signaling to market participants, rates are getting cut, that is not good, right? And even though things might be humming along just fine, that start of the natural kind of cycle of cuts, people start to kind of take their money to safer places, even when things are good, right? Even when things are growing a little bit. But it's the fear of recession. And so that's the weird part of today, right? And being the first time in 4 years, having rates at a point that they haven't been for decades, right? For so high, for so long. Yeah. It's kind of a roll of the dice on what's going to happen.
So when you think about the investment strategy right now and the thesis around which companies should be which companies should be held, and which companies should be sold, I mean, what are the characteristics of how people can think about that, and are there specific ones in a buy, hold, sell with this cut implementation strategy that's going to be a larger cycle? It's not just going to be one cut, hey, that's it.
Absolutely, and I think if you dive into a sector, right, technology, been extremely popular, has had phenomenal returns, right, over the last couple of years. So if you kind of narrow in, I like the more diversified approach. So if you want to be in semis, I'd say don't go directly. So a sell might be, hey, bide some time on NVIDIA, right? That could have massive price appreciation. That could also have massive price depreciation. If you're looking at a hold, strong cash positions, right? Choose somebody in the middle like a Microsoft. OpenAI, it's getting all these funding, all these investments. And even though it's kind of tied up in kind of the Mag 7 and the S&P, still a great company. And then in terms of a buy, right, go upstream if you want to be in technology and semis, like in applied materials, right, or Lam Research. Pick ones that supply Intel, NVIDIA, right, that help to really build components and fabrication, because I think they'll be less in the limelight if things go bad.
How can you identify whether or not a company has run too far ahead of its own valuation?
That's the million-dollar question, isn't it? And that's where I think it's balancing the optics and perspective of the market, right? I personally seen a lot of REITs run up to astronomical valuations, right?
On the prospect of rate cuts?
Well, and that's where it's funny. At first, it was kind of like, okay, they're just kind of going with the rest of the market, but then they kept going. We're talking 100, 200 times PEs that they really have never seen. And now, sure, is there a potential that their profits are doubling and tripling?
Yeah.
I would say no, not to that extent, and that's where it's interesting, kind of where the S&P's at near all-time highs, right at this maybe apex of where things are going to happen, and it's buy the rumor, sell the news on the rate cut for some of these names.
Tony, always a pleasure to have you here in studio with us. Tony Zaparo, EquitySet CEO, joining us here on Yahoo Finance. Thanks, Tony. Absolutely. Well, housing starts bounced back in August as builders ramp up new projects and amid lower borrowing costs. Yahoo Finance's Danny Romero joins us on what this means for the new home market. Hey, Danny.
Brad, good news for the new home market. Housing starts rose over 9% in August to a seasonally adjusted annual pace of 1.36 million units. This is the fastest pace since April, and we can kind of see this in the chart of this kind of evolution here. Now, building permits, a measure of future construction for single-family homes, hit a 4-month high, while multifamily projects fell for the first time since May. What does this all mean? Builders have been waiting for demand to pick up and to help offload some inventory of unsold homes that's been hovering at the highest level since 2008. At the same time, mortgage rates are lower as there's this expectation that the Federal Reserve will cut interest rates. Still, it could take some time to see some consistency in construction projects. Now, shifting over to mortgage demand, Mortgage Bankers Association reported this morning that total application volume climbed nearly 15% last week, given the growing expectations that the Fed will begin cutting rates. Meanwhile, homeowners, they're not waiting on the sidelines no more. They are jumping in at the opportunity to refinance their existing home loan. Brad?
And so, Danny, while we've got you, we're expecting a rate cut announcement this afternoon. You may have heard about it, either 25 or 50 basis points. What kind of risks does this bring for housing stocks? And what should investors be looking at when thinking about the housing sector?
Housing stocks have been on a rally since July, driven by lower mortgage rates. However, analysts at Bank of America warn about 3 risks to watch out for despite the expected rate cut. First, housing stocks typically outperform during times of rising unemployment and lower rates. However, they typically underperform ahead of a recession. 2, mortgage rates have already priced in significant rate cuts, which means that rates probably won't fall any further. And the last risk to watch out for is home builder stocks are trading at over 2 times their price to book ratio, which is elevated compared to prior periods heading into a Fed rate cut cycle. Brad?
All right, excellent breakdown there, Danny, for all the things to watch in the housing market here. Yahoo Finance's own Danny Romero. And a reminder to our viewers, the Fed's September rate cut decision is out 2 p.m. Eastern Time, followed by Fed Chair Powell's press conference at 2:30 p.m. Yahoo Finance will bring you coverage of today's meeting starting at 2 p.m. Eastern. Coming up later on in the hour, we're going to be talking to the personal finance experts from across Yahoo Finance all week long. Today, we've got Robert Powell, host of Decoding Retirement, to give actionable tips for building your nest egg. But first, Yahoo Finance's own Rochelle Akufo and Kendall Little discuss the impact of Fed rate cuts on credit card users.
Well, this week, the Federal Reserve is expected to cut rates from its over 20-year high. Well, what does that mean for you and your credit card interest rate? To discuss, we have Yahoo Finance's very own Kendall Little. So, Kendall, what should we be keeping an eye on here?
Yeah, so just to start off, we do know that the past couple years of higher interest rates have been tough on credit card holders. You know, if we look back at 2022, before the current rate hike cycle began, average credit card rates were around 16%, and today they're over 21% on average. Though we've seen plenty of credit cards with potential APRs even as high as 30%. So the important thing to remember if you're a credit card holder is that while credit card rates are affected by the Fed, it's not the only part of the decision from your credit card issuer. Based on what we've seen in the past, even if the Fed does lower rates this week on 25 basis points or 50 basis points, that's not going to make a significant difference in what you're being charged on your credit card. The best thing that you can do right now then is to not wait for the Fed, start making moves today to pay down your credit card debt. One tool that we really like and recommend is a balance transfer credit card. These credit cards have 0% APRs for anywhere between 12 to 21 months. So that means that you're going to have at least a year to pay down your current balance without taking on any extra interest charges. But you do need to account for balance transfer fees. These can be between 3% and 5%, but that's going to be a lot less than you would take on in interest otherwise. Another option for some people for consolidation might be a personal loan. You're probably not going to find personal loans today with 0% APR like those balance transfer cards, but these loans can have much lower rates than your credit card will. And then just one other thing to really remember is not to add to your credit card balance as you're trying to pay it off. For some people, that might mean switching to cash or a debit card while you're working on that debt. But whatever you're going to forfeit in rewards or cash back during that period, again, is going to be a lot less over time than taking on extra interest.
Indeed. Better to not add to that debt if you can. Appreciate you breaking that down for us. Kendall Little, thanks so much.
We're just hours away from the Fed's decision, and they're expected to cut rates for the first time in 4 years. To break down what ETFs might stand to benefit from lower rates, we've got Tushar Yadava, who is the BlackRock Multi-Asset Strategies and Solutions Director and Strategist, as part of this week's ETF report, brought to you by Invesco QQQ. All right, great to have you here in studio, Tushar.
Thank you for having me.
Absolutely. Let's talk about this. I mean, we've all just been building up. The pressure has been mounting for those FOMC members who have been sitting in their room debating, deliberating for 2 days now.
Right.
And it's all come down to this. And so now for the ETF strategy that people would be wise to position themselves around, what is the most pressing decision that people need to make around whether or not an ETF is valid or now out of position with their portfolio strategy?
So let me maybe break it down with 2 time horizons for people, right? I think over the long run, and please don't get me confused on this, generally when the Fed cuts rates, it's a winner for stocks. It's a winner over time. A year from now, you'll look back and be thankful that you were purchasing stocks. If you were long stocks, you'll be thankful for that. But this little period that we're in, and recently with portfolios that we manage, we've been doing this as well, just trimming back some of that stock risk. We've been overweight equities relative to fixed income. And now we're starting to dial that back. Just there's a lot of uncertainty, not only with this cut, October's seasonally the worst month of the year in the calendar, and you've got obviously election season coming up. That's a lot for a market to digest. We're looking into things like core bonds, like the IUSB, maybe a little bit more income, like BINC, BINC, and being a little bit more flexing from growth to just adding a bit of value back into the portfolio, especially in the developed markets. And EFV is kind of what we've been using to lean into that.
What is a good rule of thumb for returns that you should be targeting, especially as you're looking across fixed income ETFs right now?
Yeah, I think, you know, everyone can always focus on yield, and if you're only ever thinking about yield and withdrawing, maybe it's a different conversation. But the majority of people have fixed income in their portfolios as a ballast. Something to sort of put the brakes on the engine where the gas is the stocks, and that's what's driving things. So if you're thinking about it from that standpoint, look, bonds do benefit in rate cuts. You tend to see falling rates as good for bond prices. But overall, you got to think about it as something that's going to basically be a bit of a ballast for your equity risk at the moment. And that's really what bonds should be doing in your portfolio.
And US specific, or are there international opportunities when it comes to an ETF positioning like this?
You can get cute. I think it's much easier to sort of simplify.
It's like my golf game. Right? You could get cute, but
do I really want to try and do the bump and run, or just, you know, a simple normal pitching wedge, right? And you know, I always go for the bump and run, and it never works.
Oh boy. So all of these things considered here, as we're thinking about what this could trigger for other moves around the world too, because that is the international consideration with regard to how other central banks will also govern their decision making. Is there an ETF kind of spillover effect, if you will, that people could be tracking up against?
Yeah, absolutely. It's a great question that you asked, because I think when we looked at international, and in the US, we're very growth focused, very tech focused, those are the winners.
Yeah.
That's where earnings growth is really driving forward, and you're seeing the most earnings potential over time. There hasn't been that broadening out trade. Maybe earnings are starting to inflect a little positive in that X-growth, X-tech cohort. Internationally, we've seen the value stocks actually benefit. And I think that's partly because you're seeing central bank action in, you know, across the ECB, the BOE, the Bank of England, starting to think about cutting rates, because the Fed is starting to think about cutting rates as well, and having to sort of lead that pack. They've obviously led off before the Fed. Now the Fed's going to come in, and they have to keep going, or they're going to risk seeing sort of some interest rate parity maybe change their currencies. So they have harder problems to manage outside the US, and the US, you know, it's the world's currency and everyone else's problem. So it makes life a little bit easier for them.
You know, it's so interesting, because the Fed cutting is because they're trying to be proactive or preempt what is either a hard landing, as some are expecting, or it could be a true recession. And so with all of this in mind, where are the ETFs that have outperformed in the hiking cycle that are now perhaps set to underperform as the Fed begins to cut rates because they're trying to avert something more broadly in the economy?
Yeah, it's funny. When you think about adjusting rates, that's a uniform condition for stocks, right? Every stock is sort of now looking at a different financing rate, funding rates, different sort of financial condition environment. In those in the hiking cycle, that disproportionately hurt growth and tech. It probably, and historically and empirically, it shows disproportionately benefits, especially on the growth and the tech side, when you see that kind of front end of the curve re-steepening because of rate cuts.
Absolutely.
So that's an area that over time I think will work and you should lean into. It's just with that uncertainty of this next couple of months, it's probably something we're looking at is just taking a little bit of risk off the table, letting bonds do their job for you, and then moving into stocks maybe by the end of the year again, buying back in again.
Tushar Yudava, who is the BlackRock Multi-Asset Strategies and Solutions Director and Strategist, joining us here on set. Thanks so much for the time.
Thank you.
Absolutely. Everyone, the one thing at the top of investors' minds, it's the Fed decision. Yes, our own Julie Hyman is at the Future Proof Conference out in Southern California, catching up with some top names and getting their takes on what to expect today, including Ritz-Hold's Wealth Management Chief Market Strategist Callie Cox. Julie got her first perspective on the debate between a 25 and 50 basis point cut. Hear this.
Well, I'll start off with I'm not sure size matters here. The economic impact between a 25 and 50 basis point rate cut is very small, at least from on the loan rate side, around $4 billion, which is nothing in the grand scheme of things. I think it's more important what Powell says and what we see in terms of rate projections, how quickly they'll be cutting rates over the next year.
So even if it's 25 or 50 basis points, sort of how he couches it is more important than the number itself. How do you want him to couch it? What's the sort of ideal scenario?
Yeah, well, words matter, first of all. Right. So every single word he says, investors are going to parse through it.
No pressure.
No pressure, Powell. I think it's important for him to speak truthfully about where the economy is, and he does it already, but there are a lot of questions around what the job market looks like, and obviously if the Fed is cutting rates, then they see some risk to unemployment. So, I want to get updated context from Powell on the job market, how worried he is about unemployment over the next year or so. He's been saying he's not worried, but it's time to cut rates. So what's going on there? What's the dynamic? And if we get a 50 basis point cut, I think he's going to have some explaining to do around why. Why if the job market isn't crumbling as quickly as people think.
And then what about market reaction to all of this, right? Because this is, we always say it's the most anticipated Fed meeting. This one really is, it's a big one. And we have seen some trepidation. It was sort of like 50 was off the table, then it was back on the table. There's been so much discussion about it. What happens when we actually get the news?
Yeah, well, the Fed's in a tough place. If they cut 50 basis points, markets will have to balance the fact that they're getting to neutral faster with the fact that there might be an ominous reason for them cutting 50 basis points, which, to be clear, I don't think that ominous reason is there yet. But 50 basis points and big rate cuts happen around recessions. That's just what history has shown us time and time again. So investors are going to have that in the back of their minds. If they cut 25, obviously that's not what the market is expecting. The market probably wants more. So Powell's going to have to balance that with, hopefully a dovish rate projection or a dovish, a very loose talk around what's going to happen over the next year and where we're going with rates, not necessarily what we're seeing that day.
And sort of, what are you guys telling clients in terms of positioning around all of this?
Yeah, well, we've been talking about it for a while because we're already seeing savings rates move down. We've obviously seen the 10-year yield move from 4.7 to 3.7. We're saying lock in rates now. Understand why you're holding cash where you are. Now is the time to invest in risk assets, especially if you're a long-term investor and you can handle some swings that we see. At the same time, prepare for a recession. We don't know if a recession is around the corner. Nobody knows that. But the job market is weakening. We're moving in that direction. Have a game plan ready in case you do lose your job or we do see a 15 to 20% drop in prices.
All right. Thanks, Callie. Appreciate it.
Yeah, thanks for having me.
And a reminder to our viewers that the decision is out at 2 p.m. Eastern Time, followed by Fed Chair Powell's press conference at 2:30 p.m. Yahoo Finance will bring you coverage of today's meeting starting at 2 o'clock Eastern Time. Coming up later in the hour, Robert Powell, host of the Decoding Retirement podcast. He joins me to talk all things retirement savings as part of our theme week, Investing 101, 5 rules to build wealth. Stay tuned. 62% of Americans own stock, according to Gallup. For everyone else, the investment process might feel daunting. To break down how you can get started in the market, we have Ryan Victorin, who is the Fidelity Investments VP and Financial Consultant and Certified Financial Planner. Ryan, great to have you here in studio with us.
Thanks so much for having me.
So, first and foremost, I mean, it's really boiled down to something so simple as how do you just get started? How do you identify where you should be building a strategy and making sure that you can become an investor like the other percentage of people who were cited in that Gallup poll?
Absolutely, and I think it's really important to just zoom out and create a framework for yourself. So I'll give you a quick three-parter that I like to phrase it around. One is the who, the what, and the when. Who are the important people in your life that you're planning for? Are you married? Is it just you? Do you have kids? What is it? So who are the people? Second is what? What are we actually planning for? What's this goal that you're actually working towards? Are you young and you're trying to buy your first house? Is retirement a goal for you, which it is for most people? And then also, do you have a baby? Are you trying to send your kids to college? Whatever the sort of goal is. And then the third, I should say, is when. When are these goals happening? Are you 5 years from retirement and you're now in the position to start saving? Is it 30 years away? Are you buying a house in 5 years, 10 years? What's the goal? So that's the framework to start with, and then you can get started with what to do next.
So how do you even go about picking out, say, a security, an equity, a stock, and then tracking the performance as well?
I mean, I think the first place to start is what type of investor are you really, right? Is it an actual stock that you're looking for? Is it a fund that has stocks? Is it that you need a little bit more help than that and you want to sort of evaluate it? But once you know how much stock you want in your account, you also want to know, really, is it still serving the purpose? And will this work with what I want to do down the road, right? But when you think about how much risk you want to take, how much you put into any one stock, which is really important, because you don't want too much of a good thing that takes too much risk, obviously. But it really just depends on what that goal is, and then how you feel comfortable with your own knowledge base, and whether or not you really want to pick stocks yourself, or you want to go with funds that represent the stocks that you're kind of interested in.
Just as a follow-up to that, I mean, there's a lot of emotion when it comes to money.
Yes.
How do you remove emotion from your investment strategy?
Emotion is there, and it really drives a lot of fear, right? And so I always say, I have to say it again, zoom out and go back to that original framework. And when you start to feel a little bit anxious about it, or even if you're just fearful to even get started in this process, just start to think about, okay, is what this investment is doing, or either is going to do, I think, before I buy it, is it supporting that goal that I have? And especially when there's things like, the Fed is going to potentially raise rates, or there's market volatility, or whatever it is, sort of move past the noise, try to take a deep breath and come away from the fear about it and say, is this still serving my purpose? So that we can see, do we keep it? Do we sell it? Do we need to protect it? And how far away are you from the goal will drive a part of that too.
How do you decide if you should be actively looking for new investments or just holding assets long term?
That's a really great question. So one is, obviously, again, is it still serving the goals? But also, I would say, what account is it in? Because it's in a non-IRA. The IRS just loves being involved in whatever we do, so we have to make it from a tax decision as well. But whether or not you still think it's serving your purpose, and I'll give you an example. Let's say you are in retirement, okay, and now you don't need as much growth, as much income. So we say, okay, maybe I don't need a pure growth stock. Maybe I need one with a dividend that might come off it. And maybe you're much younger and nowhere near retirement, and you say, I really want to grow this, and so I want to keep it for the long haul. So it kind of depends on the timing.
And while we have you, what do investors need to know about selling stocks? You've held on to something for a while, perhaps, maybe 5, 10 years even.
Yep.
What about when you're ready to sell?
Yeah, I think, again, taxes is a consideration, right? Again, it's like, hopefully grown that investment 5, 10 years, and you have to be kind of careful and understand what the implications are. But again, it's always going back. Is it still actually serving me? But when you do sell it, you have to think about, where's it going to go? Are we selling it and we're just putting it in cash because we might need it now, or selling it because we want to get into a different investment? So it's a kind of a two-parter when you sell it.
Ryan Victorin, who is the Fidelity Investments VP and Financial Consultant, CFP. Thank you so much for taking the time.
Thanks.
Coming up, day 3 of our investing theme week, we'll give you the third of 5 rules to build your wealth, featuring the host of Yahoo Finance's Decoding Retirement podcast, Robert Powell, coming up next. We're going back to the 101 here on Yahoo Finance with our theme week, Investing 101, 5 rules to build wealth. Today, we give you the third rule, build your retirement nest egg. We have an expert here to give you some of the actionable tips for building your retirement fund at each stage of your career. I'm joined by the man, you've heard his voice before, you've seen his face, Robert Powell, host of Yahoo Finance's Decoding Retirement podcast. Great to have you here in studio.
Brad, thanks so much for having me.
Absolutely. So let's start with early in your career. What should young professionals do to really start setting themselves up for retirement?
So I think rule number 1 is to pay down your debt, whether it's student debt or your credit card debt, especially your credit card debt. The next thing I would do is consider investing in your human capital. When you're younger, your human capital represents the largest asset that you have, about 90% relative to maybe 10% of your financial capital. Then think about contributing, if you're in the workforce, contributing to your 401k, enough to get your full employer match. So you might have to invest or save 6% to get 3% from your employer, giving you a 9% savings rate. And then think about investing aggressively. You have a long-term time horizon, at least 40 years of work and maybe 30 years of retirement, so that's a 70-year time horizon. You can afford to invest 90% of your assets in equities.
So with that in mind, I mean, that's early in your career. And then once you get mid-career status, what adjustments do you need to make?
Yeah, so this is a really difficult time, right? You probably have a family, you're balancing different goals, you're trying to save for retirement at the same time as you're trying to save for your children's college education, and you've got limited resources. So you have to think about, how do I allocate my resources? One thing to consider is you can't borrow for retirement, you can borrow for college. So think about that as you think about divvying up your assets. The other thing is, if you haven't started maximizing your savings toward retirement, think about trying to hit the 15% mark. Think also, too, about if you have a Roth 401k option, maybe consider using that. If you have a health savings account at work, think about using that. If you have a spouse who doesn't have an employer-sponsored plan, maybe a spousal IRA. And then lastly, if you're a gig worker, think about setting up maybe a solo 401k or a SEP IRA to help you save for retirement, because you don't have a retirement plan. You are the employer and the employee in that case. And then the last thing I would say is create an investment policy statement so that you get a sense of what's your investment time horizon, what are your investment goals, what's your risk tolerance, and then rebalance your assets based on the factors that are in your IPS.
All right, so I'm thinking about this. People living longer and longer here. I mean, so you've got to stretch your dollar a little bit more. Once you're in retirement, how do you make sure that you're in the best position to live a long and happy life?
Yeah, so there are a couple things. I always think about retirement as a case of being rows and columns. Think of it as a spreadsheet. And each year you need to be looking at your expenses and adjusting them accordingly. And then making sure that you have sufficient income to match those expenses. And what I might say is, if there's a shortfall between your income and your expenses, maybe go back to work part-time. The other thing is, people worry about outliving their assets in retirement. It's called the risk of longevity. And so oftentimes what you might need to consider is investing in an income annuity, which is something that will pay you an income for the rest of your life. And that's one way to deal with or mitigate or manage the risk of longevity. The other thing is, if you also need to think carefully about your asset allocation, just as you did when you were mid-career, but now maybe you need to be a little bit more conservative with your investments. So you may want to rebalance your portfolio so that it has a little less risk and a little more income.
Okay, so Bob, you talk about retirement experts all the time. One of your recent guests that you had on, Ann Lester, shared a roadmap for savings targets as well. I want to take a look at this clip for our viewers here as well.
There are certain savings targets that people should aim for. 1 times your salary by age 30, 3 times by age 40, 8 times by age 60, and 10 times by age 67. So the important thing is, if you have multiple accounts or one account, to use these benchmarks 1 times your income at age 30?
Absolutely. I think that's a really good rule of thumb. It's, when you get closer to retirement, if you're in your 50s or 60s, you might want to start digging in a lot more to these general rules of thumb. But certainly in your 20s, 30s, and 40s, I think those are very practical sort of ways to gauge whether or not you're kind of roughly on track.
All right, so Bob, I got to know your key takeaways from that conversation, from that interview.
Yeah, so I think the interesting thing from my perspective is, think about this rule of thumb and set these savings targets as your goal. And then along the way, you can adjust them, as Ann Lester said in that, as your finances become more complicated. But for the moment, shoot for those targets, and that will help you stay on track for retirement, to make sure that you have a sufficient nest egg to pay for your expenses in retirement.
Absolutely. So you do a segment called Ask Bob. And I mean, as you can see, I've got my laptop in front of me, so I wanted to pull up my spreadsheet. I'm just kidding here. You essentially have viewers and listeners email you questions, and you'll answer live on air. So we have the email address up on screen right now if anyone has questions for Bob, and we wanted to do that with you today. Like I mentioned, we're not going to do it with mine, but our producers submitted a question, and they want to know, how much money do Americans need to live comfortably in retirement? I mean, this is different for everyone's definition of comfortable, but is there a general ballpark figure that we've come to as a consensus?
Yeah, so there's a general rule of thumb that you should aim to replace 70 to 80% of your income in retirement that you had prior to retirement. Now, it may be different for different sort of income quintiles, but generally use that as your benchmark and use the saving targets that we just talked about.
All right. Thanks so much for joining us here, Bob.
Thank you, Brett.
First of many appearances. You got to come back here on Wealth. He's got some great guests actually coming up, including Jennifer Openshaw, good friend of Yahoo Finance, CEO of Girls with Impact. You've also got Ann Ackerley, who is the Senior Advisor of Retirement over at BlackRock, and Michael Learsh, Wells Fargo, Head of Advice and Planning. Much more to come there. Be sure to tune in to Decoding Retirement with Robert Powell every Tuesday, 12 p.m. Eastern on all streaming platforms. And we'll have more investing rules for you to build your wealth throughout this week. We've got Tiffany Alichet, who is the host of Money Glow Up. She's joining me on the show tomorrow. Don't want to miss that.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator. Welcome to Capital Gains World for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Bitcoin is under pressure ahead of the Fed's rate decision. Our very own Julie Hyman is at the Future Proof Conference out in Southern Cali, catching up with some top names, including Michael Novogratz, CEO of Galaxy Digital. Julie got his outlook for crypto, given the busy year ahead.
Do you have a price target for Bitcoin?
You know, I do think this year's interesting. If we get through this 73 area, then it's going to go a lot higher. It's going to take I think the Fed's going to cut rates tomorrow. If it's 25 or 50, doesn't really matter because they're going to be really dovish. I think they'll go 50. That's going to set up a series of rate cuts. So it goes to the crypto narrative. And it's going to be around this election. And I think getting through the election and seeing if Trump wins, off to the races, and if Harris wins, what she comes out with her crypto policy. As long as it's decent, I think we take that high out and we're much higher a year from now.
Thank you, Julie Hyman, for bringing us those insights there. Also, we got to switch gears. A new report on women in the workplace shows women have made progress in corporate America over the last 10 years. Today, women make up 29% of C-suite positions compared with just 17% in 2015. But still, women are decades away from reaching full equality at work, according to the report by McKinsey and Leanin.org. For more insight into the study, I'm joined by Leanin.org co-founder and CEO Rachel Thomas and McKinsey senior partner Alexis Kurkovich. Alexis, let's start with you. Give us some of the highlights from the report.
Well, you hit the punchline. We're at 29% women in the C-suite. That's a huge gain from 10 years ago, which was 17%. But those gains are incredibly fragile. And here's why. When you look under the hood, the way companies on average got that representation in the C-suite was they added a seat at the table. And they tried hard to fill that with a woman. That seat was typically a staff position. So we're talking CHRO, chief legal counsel, a finance leader. Those are really important, but you can't keep adding seats to the table to get yourself to equality. And in addition, they mostly looked outside their company for that talent, which means they're not growing the next generation inside the way we need to see. So good progress at the very top, but a lot of work to do to see that that could be sustainable. And that's why we look at the picture and project forward and we say best case scenario, 22 years for white women, 48 years for women of color. That's 2 generations before we see full equality in the workplace.
Yeah, too long. Rachel, when you think about what we've just broken down with the top line takeaway here on the companies and the corporate side, how can they ensure that they are making, and not just making strides, but also making sure that they have the right policies in place, the right activity in place for all of their corporate operations to ensure that there is that ability to grow out talent both internally within the company while also recognizing talent that is very applicable in skill sets to what their company is looking to do in future decades, future near-term periods of time as well.
One of the big findings this year was despite commitment to both gender diversity and racial diversity increasing over the last decade, this past year, it slid back. So one of the first things we need is organizations to recommit to diversity, equity, and inclusion, and really double down on their efforts. And an area they should focus on is what we have for years called the broken rung. So we know that women are disadvantaged from the very first step up to manager. For every 100 men promoted to manager, only 81 women were this year. And rewind back to 2018, it was 79 in 2018. That means the numbers have hardly moved. And what happens then in a typical organization, 2/3 of managers are men and 1/3 of managers are women. So this is organizations not investing in early career women, which means they're not investing in their next generation of women leaders. So that's an area where I would really ask organizations to apply a laser focus.
You know, Alexis, in this election season, we've heard so much about diversity, equity, and inclusion, and specifically on one side of the aisle, how that's been called in and almost polarized. How might that have a larger looming impact as well, broader ramifications, given the fact that it's almost being used as a political punching bag right now?
Well, look, the whole objective of inclusion and achieving diversity in the workplace is that all great talent has equal opportunity to rise. So this is not about a zero-sum game. This is about creating opportunity for all. And we see that in companies that do it really well. When they have really strong processes in place, when they debias the system, they don't just add better maternity leave policies. They add better paid paternity leave policies. They don't just teach managers how to coach and develop women, they teach managers how to coach and develop all employees. And that's why you see the results for the companies that really focus on this actually have healthier performance across the board. And so that's really what we're advocating and supporting. And I think the good news behind it is we still have very high commitment rates from companies. But as Rachel said, like the trend is a drift slightly back. And what we really need in this moment after the progress that has been made, that's been hard fought, is to see companies really double down on that rather than stepping back.
Certainly. Rachel, just lastly, while we have you, what can men do as well to be good allies in ensuring that there is the elevation of more women into these positions?
Men can be a powerful force for change, particularly because they're more likely to hold the most senior positions in organizations. And yet we know senior level men are the most optimistic about the state of the workplace. 9 in 10 think opportunities have gotten better for women. Only half of women of color think that. 1 in 10 don't think there's gender bias in the workplace, but 2/3 of women report experiencing gender bias. So I think senior level men in particular, continuing to educate and then role modeling the right behavior, because we know that everyone in the organization, and particularly early career men, they follow where senior level men lead.
Rachel Thomas, Lean In co-founder and CEO, and Alexis Krivkovich, who is the McKinsey senior partner. Great to have you both here on the program with us. A very important conversation and appreciate it. Would love to check back in.
Thank you.
Thanks. Everyone, that's it for Wealth. I'm Brad Smith. Thanks so much for watching, and stay tuned. Yahoo Finance will bring you coverage of today's Fed meeting and that highly anticipated rate decision here. Josh Lipton and Shauna Smith will bring you that coverage starting at 2 p.m. Eastern. You do not want to miss it.